So without wasting time, let's start. So in our first subtopic, we are going to look at the definition. Accounting is a language of business, or we can also talk about is a service activity that is all about recording, classifying, summarizing accountable events in order to communicate quantitative, qualitative, and financial economic information to different users in order to make relevant decisions. Then we have also the phases of accounting process. So they involve recording phase, which involves the routine and mechanical process of writing business transactions and events in the books of accounts, or the books of original entry, or simply the journals, in a chronological order in accordance with entities and other established accounting rules and procedure. Another phase is classifying phase, which involves sorting and grouping of similar transactions into their respective classes by posting them into a ledger. Then you also have summarizing phase, which involves the preparation of financial statements or reports. It is usually done periodically, either monthly or annually. Then you have interpretation, which refers to the analysis of the accounting information. So these are the four phases of accounting process: recording phase, classifying phase, summarizing phase, interpretation phase. In the branches of accounting, you have various branches such as financial accounting, tax accounting, cost accounting, managerial accounting, and also auditing. Then, what are the objectives of accounting? The moment that we are learning accounting, so what are these objectives that we need to understand? We can talk about systematic recording of transactions. This is basic objective of accounting is to systematically record the financial aspect of business transaction, that is bookkeeping. Then the second one is ascertainment of results of the above recorded transactions. It has to ascertain the results. Then the third, it is the ascertainment of the financial position of the business. So that is also another objective. The fourth, it is providing information to the users for rational decision making. And finally, to know the solvent position of the business. So those are the 5 objectives of learning the accounting. And who are these users of accounting information and their needs? We have an acronym referred to as guest groups. So we can start with the government. Especially the government needs accounting information during its day-to-day operations, so that to assess the amount of tax to be paid by the business or an individual. Then you have the employees. Employees, if you're working in an accounting, finance, or trade department, the accounting information becomes essential. Then you have suppliers and other trade creditors. Those who are providing merchandise to different business establishments, such as Cola or Pepsi, they need to understand the business well. Then you have the customers and the consumers. They also have to have the information in order to determine the continuity of the business. Then you have the readers. It's similar as the similar need as suppliers They are interested in accounting information to enable them to determine the ability of the client to pay their obligation and the interest attached when the loans becomes due. Then you have the investors in order to make relevant decisions. Then you have the public. All of us need accounting information to know the status of the business. Then you also have the management. They need accounting information to assist for planning and decision making. So those are the most users of accounting information. Then what are these qualities of useful accounting informations? The qualities that we all need to understand. Then we have accounting information has to be relevant. It is necessary for predictive and feedback value. It has to be relevant. Then it also have to be timeliness. The quality subsets of relevance. It has to be presented in a timely manner. Then it has to be reliable or reliability. If account information is not reliable, it cannot be used to make quality business decision. Then it has to be consistency. This will help in useful decision making. Thus, it has to be recorded consistently, meaning the same accounting treatment or given type of accounting data. Then it has to be comparability. This absence of consistency. If you cannot compare accounting information for one period of time to another, then you cannot derive useful information in order to make operational decisions. And what are the limitations of accounting information? We can talk about historical. Accounting information is prepared based from past period monetary transactions. So it will be highly feasible that what happened in the past will hold on in the future, and so the accounting information may be considered irrelevant on that basis alone. Also, too quantitative rather than qualitative. Accounting information is too many figures and less of explanations. For any system to be useful, it must strike a balance between quantitative and qualitative measures. More so, it is only comparable to similar business. So accounting information makes it only comparable to business of similar nature. It is difficult to compare a service-oriented organization to a manufacturing-based firm. Then let's discuss about professional ethics. We study the integrity. A professional accountant should be straightforward and honest in all professional business relationship. Objectivity. He should not allow bias, conflict of interest, or undue influence of others to override professional business judgment. Then he should practice professional competence and due care. A professional accountant has a continuing duty to maintain professional knowledge and skill at the level required to ensure that a client or employer receive competent professional service based on current developments in practice, legislation, and techniques. Then he should practice confidentiality. He should respect the confidentiality of information acquired as a result of professional and business relationship, and he should not disclose any such information to third parties without proper and specific authority unless there is a legal or professional right or duty to disclose. Then he should also practice professional behavior. He should comply with the relevant laws and regulations and should avoid any action that discredits the profession. Then, what are the basic accounting equations? The basic accounting equation involves assets, which is equal to liability plus equity, or the capital. Assets is a resource that is owned or controlled by the company to be used for future benefits. Then, on the other hand, a liability is an amount of money owned to another person or organization. Equity will represent the portion of a company asset that shareholders or partners own. So let's look at the basic double entry rules for accounts. You have the accounts, what to record and entry in the account. So for an asset, an increase in asset, we debit. In a decrease, we shall credit. For liabilities, an increase, we credit, a decrease, we debit. For capital equity, an increase, we credit, a decrease, we debit. A revenue, an increase in revenue, we credit, and an increase in expense, we debit. So those are the basic double entry rules. Then you can also look at the regulation of accounting professions. We have objectives of International Accounting Standard Board, the IASB. One is to develop, in the public interest, a single set of high quality, understandable and enforceable global accounting standards that require high quality, transparent and comparable information in general purpose financial statements. Second, to provide the use and vigorous application to those standards. Then to work actively with the national accounting standards setters to bring about convergence of national accounting standards and IFRS to high quality solutions. You can also look at the role of the Institute of Certified Public Accountants of Kenya, ISPAK. One is to promote standards of professional competence and practice amongst members of the institute. It also promotes research into the subject of accountants and finance and related matters, and the publication of books, periodicals, journals, and articles in connection therewith. Also to promote the international recognition of the institute. Also to advise the examination board on matters relating to examination standards and policies. Also to advise the ministers on matters relating to financial accountability in all sectors of the economy. Also to carry out other functions prescribed for it under any of the other provisions of this act or any other written law, and to do anything incidental or conducive to the performance of any of the preceding functions. So those are the roles of ISPAC. What about the role of the CASNEB? For the Kenya Accountants and Secretaries National Examination Board, it prepares syllabus for accountants and secretaries examination. It makes rules in relation to the examinations. It also issues certificates to candidates who have satisfied the examination requirements. What about the role of registration of Accountants Board? This one registers the accountants that have been certified by the examination body to have fulfilled the examination requirements. Also issuance of practice certificates to those wishing to render the accounting services to the public. So those are among the roles of various bodies. So I'd like to continue in discussing our accounting concepts or the principles. So accounting concepts and principles are a set of broad conventions that have been devised to provide a basic framework for financial reporting. So we can start with the relevance. Information should be relevant to the decision-making needs of the users. Reliability. Information is reliable if a user can depend upon it to be materially accurate and faithfully represent the information that it purports to present. Then it is neutrality. Information contained in the financial statement attempting to present them in a favored light. Faithful representation. Information presented in the financial statement should faithfully represent the transaction and events that occur during the period. Then you have substance over form. Requires that if substance of transaction differ from its legal form, then such transaction should be accounted for in accordance with the substance and economic reality. You have the prudence concept. Preparation of financial statement requires the use of professional judgment in the adoption of accountants' policy and estimates. Completeness. Reliability of information contained in the financial system is achieved only if complete financial information is provided relevant to the business and financial decision-making needs of the users. Single economic entity concept, consolidation accounting. In the single economic entity concept suggests that companies associated with each other, though the virtue of common control, operate as a single economic unit, and therefore a consolidated financial statement of a group company should reflect the essence of such arrangement. On a consolidated financial statements of a group of account must be prepared as if the entire group constitute a single entity in order to avoid the misrepresentation of the scale of group activities. Then money measurement concept. In accounting, measurable concept means that only transactions and events that are capable of being measured in monetary terms are recognized in the financial statements. Then you have recognition criterion as defined by ASB and FASB require that the elements of financial statements such as assets, liabilities, income, and expense must only be recognized in the financial statement if its cost or value can be measured with sufficient reliability. Then we also have matching principle and concepts. Require that expense incurred by an organization must be charged to the income statement in the accounting period in which the revenue to which those expenses relate is earned. Then we also have timeliness principle. We refer to the need for accounting information to be presented to the users in time to fulfill their decision-making needs. Comparability or consistency principle. Financial statements of one accounting period must be comparable to another in order for the users to derive meaningful conclusions about the trends in the entity's financial performance and position over time. Under stability, transactions and events must be accounted for and presented in the financial statement in a manner that is easily understandable by a user who possesses a reasonable level of knowledge of business, economics activities, and accounting in general, provided that such a user is willing to study the information with reasonable diligence. Materiality concept. Information is material if its omission or misstatement could influence the economic decision of users taken on the basis of the financial statements. Then you have going concern. Financial statements are prepared assuming that a business entity will continue to operate in the foreseeable future without the need of intention on the part of management to liquidate the entity or to significantly curtail its operation activities. Accrue concepts require that income and expense must be recognized in the accounting periods to which they relate rather than on the cash basis. Before we move out from the going concern, what are the possible indications of going concern's problem? One can be deteriorating liquidity positions of a company not backed by sufficient financing arrangements. Another one is high financial risk arising, increased gearing level rendering the company vulnerable to delays in payment of interest and loans principal. We also have significant trading losses being incurred for several years. Then we also have aggressive growth strategy not backed by sufficient finance, which ultimately leads to overtrading. Also, increasing level of short-term borrowing and overdraft, not supported by increasing business. Also, inability of the company to maintain liquidity ratios are defined in the loans covenants. Also, serious litigation faced by a company which does not have the financial strength to pay the possible settlement. So, inability of a company to develop a new range of commercially successful products. Then bankruptcy for a major customer of the company. So those are the indications of a going concern problem. Let's continue the accounting concepts. You have the business entity concept. Financial accounting is based on the premises that the transaction and balance for business entity are to be accounted for separated from its owners. Realization concept or revenue recognition principle. Revenue is recognized by the seller when it is earned, irrespective of whether cash from the transaction has been received or not. Then we finally have the dual aspect concept or duality principle is the underlying basis for double entry accounting system. We can look at an example for a dual aspect principle. Let's look at this example. Mr. A, who owns and operates a bookstore, has identified the foreign transactions for the month of January that need to be accounted for in the monthly financial statements. He paid payment of salary to staff 2,000, sale of books for cash 5,000, sales of book on credit 15,000, receipts from credit customers 10,000, purchase of book for cash 20,000, utility expense unpaid 3,000. So under double entry system, the above transaction will be accounted for as follows. So you have to write in a solution, you look at the account title, you have to name the effect, either debit or credit. So for the payment of salary to staff, so that is a salary expense. So it will increase the expense. So we are going to debit. And also it's going to decrease the asset in the cash at bank. So we credit. Then the sale of book for cash. It is going to increase in assets, which is 5,000 we debit, and also increase in income on the sale revenue. So we are going to credit that because it's a revenue. Then the sale of books on credit, so that is a receivables. So it's going to increase in our assets, we debit 15,000, and then it is also going to decrease in income on our sale revenue. So we credit the 15,000. Cash at bank, it is going to increase in asset, the 10,000, the receipts from the credit customer, as well as decrease in assets and the receivable. So we credit the 10,000. Purchase of books for cash will increase in expense, the debit 20,000, and also decrease in our asset in the cash at bank. So that is, we credit the 20,000. Then utility expense unpaid will increase the expense, we debit the 3,000, and also decrease in asset for the accrued expense. What are the importance of accounting standards or the accounting principles? One is comparability. Another important is that it becomes transparency. It is also relevance, as well as it is important to the audience. What are the limitations of accounting standards? Alternative solutions to certain accounting problems may each have arguments to recommend them. There may be a trend towards rigidity and away from flexibility in applying the accounting standards. Also, accounting standards cannot override the statutes. I want to talk about balance sheet or the statement of financial positions. So, I start with the format, then show you an illustration. So, for horizontal format, we have the title. You can name it as shown, name of the business, balance sheet as at 1st December 20 and the year. Then on the left side, you have the assets, and the right side, you have the capital and the liabilities. So we derive this format from the accounting equation, where we know that assets equals to liabilities plus equity. Since accounting equation, which is also known as the basic accounting equation, it forms the foundation for all accounting system. In fact, the entire double entry accounting concept is based on the basic accounting equation. So before we go to the format, let's look at the assets. We know that assets are resources that are owned or controlled by the company to be used for future benefits. This can be tangible things or intangible things. So for the assets, we have the things like cash, account receivable, prepaid expense, vehicles, buildings, goodwill, copyrights, patents, all that. For liability, we know it is the amount of money owed to another person or organization. So here we have accounts payable, bank loans, lines of credit, personal loans, officer loans, unearned income, all that. For capital, we know it's a portion of company assets that shareholder or partners owns. Or we can talk about the remainder of assets once all the liabilities are paid off. The common equity accounts we have there: owner's capital, owner's withdrawals, revenues, expense, common stock, paid in capital. So all those are the different portions. So let's start with the horizontal formats. So we are going to look at the non-current assets. Here we have land and buildings, plant and machinery. You can also talk about features, furniture and fittings, can also talk about the motor vehicle. As you can see, there is an order. So non-current assets are listed in order of performance. So from land and buildings to motor vehicles. So this is the order of performance. Then you have the current assets, you have stocks, debtors, cash at bank, cash in hands. They can be many. So this is just a few. So you can also see here the current assets are listed in order of liquidity. Which asset is far from being converted into cash? For example, stocks is not yet to be sold or not yet to be realized. So when it is sold, we can either get cash or a debtor is sold on credit. When the debtor pays, then the debtor may pay by check, cash has to be bank, or cash in hand. Then on the right hand side, you have the capital. And then you have the non-current liabilities. This can be long-term loans. Then you have the current liabilities, overdraft, creditors. So these are listed in the order of payment, which is due for payment first. Like a bank overdraft is payable on demand by the bank, then by creditors. So the total capital and liability should be equal to total assets. In a vertical format, so everything is arranged on a vertical way. So we shall start with the non-current assets, land and buildings, plant and machinery, features, furniture and fittings, motor vehicles. So you have said this, they are listed in orders of performance. Then you have the current assets, stocks, debtors, cash at bank, cash in hands. So this one are listed on the order of liquidity. Then you have the capital and current liabilities, and also you have the current liabilities, which is listed in order of payment. So the total assets must be equal to the total capital and liabilities. Let's look at the instructions or the illustrations. Let's look at an illustration 1. Kamau has a business that has been trading for some time. You are given the following information as at 31st December 2014. So we have building 22,000, furniture, motor vehicles, stock data, cash in bank and hand, creditors, capital, loan. So you are required to prepare a balance sheet as at 31st December 2014. So you are going to use, let's look at the vertical format as it is mostly recommended. So we start with the title. So we are going to start with the title, Kamau balance sheet as 31st December 2014. So you have to have the debit and credit side, or you can talk about the shillings since the amount are in shillings. So you start with the non-current assets. You have building, furniture and fittings, and the motor vehicle. So we add them together. We shall get a total of 44,600. Then you have the current assets. We shall start with the order of liquidity, stock, debtors, cash at bank, cash in hand. So we also add them. So both non-current asset and current asset, after adding them together, we shall get the total assets of 76,600. Then you have capital injection of 61,600. And non-current liability, you only have one loan for 10,000. Current liability, we only have creditors for 5,000. So when you add capital plus non-current liabilities plus current liabilities, we get a total of 76,600. So both assets and capital and liabilities, they are equal. Again, let's look at illustration 2. CPM has the foreign assets and liability as on 31st April 2012. So you have the creditors, equipment, motor vehicle, stock, data, cash at bank, cash in hand. During the first week of May 2012, CPM bought extra equipment on credit for 5,520. Also bought extra stock by check for 2,280. Paid creditors by check for 3,160. Also debtor paid sharing 3,360 by check and 240 by cash. And also he put an extra 1,000 cash as capital. So what you are required to determine the capital as at 1st May 2012. Also draw a balance sheet after the above transaction have been completed. So we start with determining the capital. We know that asset equals liability plus capital. So capital is equals to asset minus liability. So we are going to put all assets together and liabilities. So for assets, equipment, motor vehicle, stock, debtor, cash at bank, and cash in hands all add up to 148,120. And for liabilities, we have the honorary creditors, which is 15,800. So when you subtract both, we get a capital of 132,320. So that is our capital. So before we draw up the balance sheet, we need to do some adjustment. We are told that he bought extra equipment on credit for 5,520. So we shall consider the effect of the above transaction on the relevant balances. So buying an extra equipment means that the equipment balance will increase by 5,520 and the creditors will also increase by the same amount since the equipment was bought on credit. Also, buying extra stock by check means that the level of stock goes up by 2,280 and the balance at bank reduces by the same. Then paying creditors by check reduces the balance on the creditors account and also reduces the amount at the bank. So debtor paying the firm reduces the debtor balance by 3,600 and increases the cash at bank and cash in hand by 3,360 and 240 respectively. Then additional cash for 1,000 increases the cash in hand balance by 1,000 and the capital balances. So if we can look at that, the summary will be you have the assets, stock liabilities. So the summary, you have assets and liability and their opening balance. Then you have the adjustment, increase or decrease, and the closing balance. So for the equipment, the opening balance of 46 increased by 5520, it will be as such. So we have motor vehicle the same, the stock, the debtors, cash at bank, cash in hand, creditors, and capital. So these are the adjustment and their closing balance. So therefore, the balance sheet will have this, the title, CPM balance sheet as at 1st May 2012. We have the non-current assets. We have two equipment and the motor vehicle. The current assets, you only have stock, data, cash at bank, and cash in hand. Then you have the capital. And the current liability, the creditors. So the amount I'm taking here are the closing balances for each. So the asset shall be equal to capital plus the liabilities, which is equals to 151,480. Welcome back. Today I want to talk about the source documents. So we shall going to start with quotation. So what is quotation? Quotation is used to let a potential customer know the cost of goods or services before they decide to purchase them. So those are the term of a quotation. What about a purchase order? This is a commercial document issued by a buyer to a seller indicating types, quantities, and agreed price for products or services the seller will provide to the buyer. Then we have statement of account or the account statement. It's a record of the transactions that have occurred on a customer's account during a specified period of time. Then we have another source document called remittance advice. This is a letter sent by a customer to a supplier to inform the supplier that their invoice has been paid. What about the receipts? Receipts are raised by the firm and issued to the customers or debtors when they make payments in form of cash or checks. We have petty cash vouchers. They are usually a small form that is used to document a disbursement from a petty cash fund. Mostly it uses the imprest system. Then you have the sale invoice. This document is sent to request payment for monies owed for goods that were delivered or services that were rendered. We also have a purchase invoice. It's released by the creditor and sent to the firm when the firm makes a credit purchase. A credit note. It is raised by the firm and issued to the debtor when the debtor returns some goods back to the firm. Then we have a debtor note. It is raised by the creditor and issued to the firm when the firm returns some goods to the creditor. Bank statement or the account statement. It's a summary of financial transactions which have occurred over a given period on a bank account held by a person or a business with a financial institution. So those are the source documents. So right now we talk about books of original entry or the journals. So a journal, we can say, it's an accounting record that is used to record the different types of transactions in chronological order or date order. So there are various types of journal. We can start with the sales journal, which is a special journal where credit sale to customers are recorded. Purchase journal is a special journal where credit purchases from customers are recorded. What about returns inward journal? You can also call it sale returns book. This is also a special journal that is used to record the returns from debtors and allowance of goods sold on credit. Returns outward journal, we can also call it purchase returns book. It's a special journal that is used to record the returns to creditors and allowance of goods purchased on credit. The cash book is used to record the receipt and payment of money by the business in form of cash or through the business bank account. So that is what we call a cash book. The petty cash book is a special file that is set up and used for minor and unexpected cash expenses, where a check can't be written or the amount is so small that you don't want to write a check. This is what I've said that it involves the imprest system. The imprest system is a system of accounting operates on a simple principle that the cashier is refunded the exact amount spent on the expense during a particular financial period. So he is refunded the exact amount spent on the expenses during that period. Then finally, you have the general journal. This one is used to record unusual or infrequent types of transactions. Let's now discuss about computerized accountings. So, what are the objects of introduction of computers in accounting? We can say it is a labor saving. Why is it a labor saving? Because the main aim of introduction of computers in accountings, it is to save on labor costs or increase in the volume of work handled by the existing staff. Then you have the time saving. Their computers should be used whenever it is important to save time. Accuracy. Using computer, work can be done without any errors or mistakes. And also it helps to locate the errors and frauds very easily. We have a minimization of frauds. So computers are mainly installed to minimize the chances of frauds committed by the employees, especially in maintaining the books of accounts and handling cash. We have effects on personnel. Computer will reduce the hardness of work and fatigue, and do that to the extent to improve the morale of the employees. There are also the need for computerized accounting. So when you use computer, it arises from the advantage of speed, accuracy, lower cost of handling the business transactions, among others. We have the numerous transactions. So it's also another object. It is capable of large number of transactions with speed and accuracy. Most would help in instant reporting. It is capable of offering quick and quality reporting because of this speed and accuracy. Reduction in paperwork. Manual accounting system will require large storage space to keep accounting records, book, and vouchers and documents. But with computer, there is that minimum paperwork. Flexibility reporting or flexible reporting. It is capable of generating reports of any balance as when required and for any duration which is within the accounting period. We also have accounting queries. This is based on some external parameters. For example, a query relating to overdue customer accounting can be easily answered by using a structured query language, that is SQL. Support of database technology in computerized accounting system. So this one would be very difficult and expensive in manual accounting system, but with the computer it become instant. And also online facility. Computerized accounting system offer online facility to store and process transaction data so as to retrieve information to generate and view financial reports. We have security. They are highly secure and the data and information can be kept confidential when compared to manual accounting system. The last and not the least, scalability. The system can cope easily with the increase in volume of the business. It will only require additional data operators for storing additional vouchers. Let's look at the special features of computerized accounting system. First, it leads to quick preparation of accounts and makes available the accounting statements and records on time. Another one, it ensures control over accounting work and records. Then errors and mistakes will be at minimum. Another special feature is maintenance of uniform accounting statements and record is possible. Then easy access and reference of accounting information is also possible. Then we have flexibility in maintaining accounts is possible. Hope you are getting to make your screenshot and make some few notes in your books. Another one is it involves less clerical work and is very neat and more accurate. As well, it adapts to the current work and is very neat and more accurate. Then it adapts to the current and future needs of the business. Finally, it generates real-time comprehensive MIS reports and ensures access to complete critical information instantly. So those are the special features of computerized accounting system. So we can also look at the requirements of the computerized accounting system. We have two: accounting framework and operating procedure. For the accounting framework, a good accounting framework in terms of accounting principle, either coding and grouping structure, is a precondition. Let's become application environment of a computerized accounting system. So we need that accounting framework. For the operating procedure, a well-conceived and designed operating procedure blended with suitable operating environment is necessary to work with the computerized accounting system. Especially the computer accounting is one of the database-oriented application, while in the transaction data is stored in well-organized database. So let's go ahead and look at the benefits of computerized accounting. So which are these benefits? We have better quality work when you use computerized. The accounts prepared with the use of computers are usually uniform, neat, accurate, and more legible than manual job. We also have a lower operating costs. It's a labor and time-saving device. So the volume of job handled with the help of computer will result in economical and low operating costs. Improved efficiency. Computers will bring speed and accuracy in preparing the records and accounts, thus increase the efficiency of workers. Another one is facilitate better control. From the management point of view, greater control is possible and more information may be available with the use of computer in accounting. You have greater accuracy. Computerized accounting ensures accuracy in accounting records and statements. Also, it will relieve monotony. It reduces the monotony of doing repetitive accounting jobs, which are tiresome and time-consuming. Also facilitate standardization. It will facilitate standardization of accounting routines and procedures. Then minimizing mathematical errors. Doing mathematics with computers, errors are virtually eliminated unless the data is entered improperly in the first instant. What are the disadvantages of now using this computerized accounting? There is that reduction of manpower. So it will reduce the number of employees in the organization, which will lead to greater amount of unemployment. The higher cost. A small firm cannot install a computer accounting system because of its high installation and maintenance cost. Then it will also require special skills. It will call for highly specialized operators. Then we also have other problems such as frequent repair and power failure may affect the accounting work very much. So those are the disadvantages. What about the challenges or the problem faced in computerized accounting system? We have user training. The users of using computer accounting software, they need to understand the concept of the software. Hence they should undergo proper training. Another challenge is system dependency. Using a computer solution makes the user to depend fully on the computer system necessitates the availability of computer at all times. Then we have hardware requirements. A full-fledged computer system with a printer is required to operate the computerized accounting system. So we need additional hardware. System failure. So when the system crash, e.g. the hard disk crash, there is the high risk of losing the data available on the hard disk drive at any point of time. We also have backups and prints. So backups of the data should be done regularly so that when data is lost, it can be restored from the floppies or the backups. We also have the vouchers management. So accounting software allows easy alteration of data. So if a voucher is wrongly placed in a long head, it will be very difficult to sort out and bring back to the voucher. So a good voucher management is very essential. Lastly, we have the security. So additional security has to be provided because improper handling of the system, the hardware, the software could be very dangerous. So password logs, etc. have to be set so that no unauthorized person can handle the system. So those are a few challenges of using computerized accounting system. So I'd like now we talk about the journals, the book of original entries. We shall discuss how they are done and some of the examples. So we can start with the sale journal, what we call the day book. So first, we are going to look at the steps in generalizing the credit sales. So step 1, we are going to enter in sale invoice. That is the first step. Step 2, should list the credit sales in journal, in the sales journal throughout the period. Then step 3, post to data account throughout the period. So if it's the sale ledger or the data account, you debit the sales. Step 4, you transfer the total sale account at the end of the month. So in the general ledger, we are going to credit. So let's look at an instruction here. So in 2020, July 1st, we sold goods on credit to Fish for shilling 100. Then July 15, credit sale to Yemi, shilling 200. And July 25, we sold stock for credit, shilling 300 to Lali. So in our solution or the sale journal, it has to have a title. So we should have a title sale journal, then include date, details, invoice, number, and the folio and the amount. So the folio, you can skip the folio number, but sometimes you need to write it. So here you have the date 2020 July 1. The details is the person, so the fish. Invoice 1, we can talk about the folio as SL or the sale ledger. Then amount 100. We go to July 15. Credit say to Yemi for 200, and then you have the July 25 for Lali. which would be invoice 3, SL, and 300. So we have indicated all this in our sales journal. So on July 31st, we need to do the step 4. We transfer the total to sale account at the end of the month. So transfer to sale account. We are going to transfer the total of this to the general ledger, which is 600. And remember this, we are going to credit. So that is all about the sale journal. So these are the processes, or the steps. You have to enter the sale invoice, then you list the credit sale in sale journal throughout the period. You post to data account throughout the period, and you transfer to the sale account. So that is all about the sale journal. So any question? Please, if you have any question regarding any topic or any subtopic, please comment below and I'll answer that. I can also give a personalized teaching or study time. Let's look at the purchase journal. So we are going to look at the same steps as a sale journal. So for the purchase journal, the steps in generalizing the credit purchase. Step 1, enter the purchase invoice. Step 2, you list credit purchases journal throughout the period. Step 3, you post to creditor account throughout the period. So you have the purchase ledger or the purchase account, you have the creditor account. So we are going to credit the purchase. As we are told, you post to the creditor account. Then step 4, we are going to transfer this total to purchase account at the end of the month. So in our general ledger, we are going to debit the total, as you can see. So in our illustration, let's look at 2021. So on August 1, we had a credit purchase from Kamau, shilling 400. Then August 20, goods were purchased on credit for shilling 500 from Hami. And August 27, we bought goods on credit, shilling 600 from Clem. So in our purchase journal solution, we also have to have a title and these details. So you have to have a date and details, invoice, the folio, and the amount. So we have been to that on August 1. We had a credit purchase from Kamau. So August 1, Kamau, invoice 1. Then the folio, we can talk about the PL, the purchase ledger. Then shilling 400. August 20, goods were purchased on credit for shilling 500 from Hami. So Hami, and then we have the 500 shillings. August 27, we bought goods on credit on Clem from Clem, 600. So after doing that, we go to step 4. We transfer the total to purchase account at the end of the month. So August 31st, we are going to transfer the total to purchase account, which is 1500. And this one we are going to debit. So you remember those are the two differences. So in our credit account, we are not going to credit, it's debit. On our purchase account, we are going to debit. So in our credit account, we credit the purchase, but in our general ledger, the total we are going to debit. Hope you have understood that. So that is about the purchase journal. So any question from that? I think it's well understood. So let's go to the sale returns or return inwards playbook. We are also going to do the same. We start with the steps and then the illustrations. So step 1, step in generalizing the returns inwards. So we enter in credit notes. Here you have to start the credit notes. And then step 2, we list the return inwards in return inward journal throughout the period. Step 3, we post to data account throughout the period. So in our sale ledger, the data account, we are going to credit the return inwards. Then in step 4, we transfer the total to returns inward account at the end of the month. So in our general ledger here, the return inwards account shall be debited. So that is what we are going to do. So if we can take a short illustration here, let's look at 209. In July 6, goods were returned from Yule for shilling 10. July 13, return goods from Jelly for shilling 20. And July 26, return inwards from Lale, shilling 30. So the solution is the same. We have the title, the return inwards journal. So you have to have the dates, the detail, the note, and the folio and the amount. So the date you have July 6. So goods were returned from, or the return inwards by Yule. So this is at the sale ledger. So we can talk about the folio to be SL. So shilling 10. July 13, returns from Jerry, shilling 20. And July 26, we have Lally, which is shilling 30. So the total on July 31st, we are going to transfer the total to return inwards account at the end of the month. So in our general ledger, we are going to transfer the 60. So we are going to debit that, the 60 shillings. As you can see, so those are the steps and an illustration from the sale returns. So let's look at the purchases returns or returns outward journals. So we start with the steps in generalizing returns outwards. So step 1, we enter the debit notes. Then step 2, we list returns outwards in returns outwards journal throughout the period. We have to list them. Step 3, we post to creditor accounts throughout the period. So in our purchase ledger, here the creditor account, we are going to debit the returns outwards. In step 4, we are going now to transfer the total to returns outward account at the end of the month. So the general ledger, our return outwards account we have to credit the total. So let's look at these instructions. In 209, July 9, goods returned to cannot for shilling 40. We have July 14. We return goods to Harlot for 50 shillings. July 22, we have returns outward to Clement for shilling 40. So solutions, the same way we have to have this title returns outward journal. So we start with the date, details, note, folio and amount. So July 9, the details is goods returned by Cannot, so shilling 40. Then July 14, return goods to Harlot for shilling 50. We have July 22, returns outward to Clement, so for 60. So the total we are going to transfer the total to return outside the account. So transfer to returns outward account will be 150 shillings, and which will be credited. So we are going to credit that. So that is all about the purchase returns. Let me give you a moment to take some notes on that. Another thing that I'd like we talk about is the cash book. So we have two types, the 2-column cash book and the 3-column cash book. So I can start with the 2-column cash book. So the 2-column, the cash at bank cash book and the cash in hand cash book, they are combined together. So you have to combine these together, the cash bank and the cash in hand. So to do this, we need to understand using illustrations. So let's look at an illustration here. So write up a 2-column cash book from the following details and a balance of as of the end of the month. So in 209, 203, 1st May. So we started a business with the capital in cash for 1,000. May 2, we paid rent by cash 100. May 3, F Atieno lent us 5,000 shillings paid by check. May 4, we paid B Omoro by check for 650. May 5, cash sale for shilling 980. May 7, N Mwangi paid us by check for 620. May 9, we paid B Musau in cash for shilling 220. May 11, cash sale paid directly into the bank for shilling 530. May 15, G Mugaka paid us in cash 650. Then May 16, we took 500 out of cash deal and paid into the bank account. May 19, we repaid F Atieno 1,000 by check. May 22, cash sale paid directly into the bank shilling 660. May 26, paid motor expense by check shilling 120. May 30, we withdrew shilling 1,000 cash from the bank for business use. And May 31st, paid wages in cash 970. So before I go to the solution, I'd like you to take a screenshot or record this so that you get this information as we do the solutions. I think you have copied. So let's do the solution. So this is the format. We have the cash book. We need to have the details, the date, the details, the cash in hand and the back, the cash at bank. Then the second, so this is we can talk about the debit side. So on the credit side, you have the date, the details, cash and bank. So those are the two. We are combining the cash in hand and cash at bank. So we are going to start with the first statement, May 1st. We started business with capital in cash for 1,000. So capital, cash. So you have cash for 1,000. We write it there. Then we have we paid rent by cash for shilling 1,000. So this is an expense. So on the credit side or the right hand side, we are going to indicate rent. We paid it on cash for 100. So that is May 2. So on May 3, F Atieno rent us 5,000 shilling. We paid by check. So this is a loan. So we indicate it on our left hand side. So our F Atieno loan, we are going to we paid by check. So we are going to indicate on the bank the 5,000. And then we go to May 4. We paid Amolo by check. So Amolo, we paid Amolo. As you can see there, on our right side, hand side, we are going to indicate the Amolo because it's a payment. So we paid by check of 650 on the cash at bank. Then on May 5, we have the cash sale. So we sold. So those are revenue. So we put them on the right left hand side. So on the left hand side, we are going to have sales for shilling. It is cash. So cash sale for 980. And then we have N Mwangi paid us by check. So N Mwangi paid us by check. So we got some revenue here for check, which is 620. N Mwangi paid us. Then we also paid B Musau. So we did some payment. So on our right hand side, we paid Musau in cash. So in cash, it is 220. Then we also Mugaka paid us. So we got some. Before that, we have the May 11. So May 11, we have cash sale. The cash sale were paid directly into the bank. So cash at bank, we have 530. Then we have Mugaka who paid us by cash, so that is 650. Then we also took 500 shilling out of the cash till and paid it into the bank account. So this is a contra. So we took shilling out of cash. So in our cash contra, we got 500, which we paid it into the bank account. So on our left side, we are going to indicate the 500, the cash. See, this is cash contra and bank contra. We have to indicate where the money is coming from. So the 500 shillings. Then we have we also repaid Atieno, the loan that he had given us. We paid 1,000 by check. So cash at bank, we indicate 1,000. And then you have cash sale paid directly. The cash sale paid directly into the bank for 660. Then paid motor expenses, the motor expenses by bank, by check. So that is cash at bank. We indicate the 120. Then we also have a withdrawal of shilling 1,000 cash from the bank for business use. So we also have this another contra. So we withdrew cash from the bank. So cash from the bank we withdrew 1,000, and also now the bank contra on the left side which was for business use, we're also going to indicate the 1,000 shillings. Then we also paid wages in cash, so the cash we're also going to indicate here, and the for 970. Okay, let's continue. So we need to add this. We need to add the total of cash on our left side and on our right side bank as well. So here the total will be, for the cash, the total will be that 3,630, for bank 7,310, and they should be equal on both sides. So as you can see, we have 3,000 or that is 630 and 710 on both sides. A minute so that I can charge. Okay, we can continue. So this is what a two-column cash book look like. So the same thing will happen to a three-column cash book. So we are going to add, there are two things we are going to add here. One on the left hand side and the other one on the left hand side. So one on the left, one on the right. So we are going to introduce something called discount allowed and discount received. So for discount received, we are going to credit the creditors, and for discounts allowed, we are going to debit the debtors. So the debtors, we are going to put them on the left hand side, and the discount received, we are going to put it on the right hand side. So the title or the heading should look like this. The same case as the two column. So we have the date detail. Now we indicate the discounts allowed. Then you have the cash and the bank. The right hand side, you have the date details, discount received, cash and bank. So anytime we see a discount received, we indicate on the right, allowed on the left hand side. So this is all about the cash book, the two column and the three column cash book. So anybody who has a question so that we can continue? You can indicate that on my comment. So there is also something that I would like to discuss before we go on. So about the contra, so sometimes cash is deposited in the bank and sometimes cash is withdrawn from the bank for use in the office. So in this case, the entries both for receipt and payment will appear in the cash book itself in appropriate columns. So these transactions are the ones that we know are known as contra transactions. Those are the ones that I was indicating as cash C and cash, or the bank C, the contra. So they have to appear in both sides, on the debit side or the left hand side and the right hand side on the credit side. Okay, we can move on. So let's look at the petty cash book. So for us to understand this, we are going to take this illustration. So the following is a summary of the petty cash transaction of M. Boga Limited for May 2010. So we received from cashier 300 as petty fruit. So in May 2, we did some postage for 10,000. Then we have some traveling for 12,000. Cleaning 15, petrol for delivery van 22, traveling 25, stationery for 17, May 11 cleaning for 18, postage for 5, traveling for 8, stationery for 9, cleaning 23, postage for 13, delivery van 5,000 mile, services for 43,000, petrol for 18, cleaning for 21, postage for 5, petrol for 14. So you are required to rule up a suitable petty cash book with analysis column for expenditure on cleaning, motor, expense, postage, stationery, and traveling. So that is what we are going to do. So we need a petty cash book for this. So a minute so that you can take a screenshot. So our petty cash will look like this. So we need M. Boga Limited petty cash book as our title. Then you have the receipts. So then you have the date of all the things that we did that were done. So then you have the total. So then we are going to prepare the columns for expenditure on cleaning, motor expense. You have the postage, stationery, and traveling. So let me take you through from day one. So I received from cashier 300 as petty fruit. So the balance brought down. So was 300. That is what we got. On May 2, we did some postage for 12,000. So our heading, we have 3 zeros there. So I'll be writing only the first digits. So we did some postage for 18,000. So postage get 18, and also the total you have to indicate it there. So we 18. So the rest will be 0. We did some traveling for 12,000, as you can see. So On day 3, did some traveling, 12,000. Cleaning we did for 15,000. Petrol, that is a motor vehicle expense, so we are going to indicate it on motor expense. From there we have traveling, 25. We have stationery for 17,000. I have them. Cleaning again on date 11, 18,000. Postage for 5. We indicate traveling for 18, for 8,000. We did some stationery for 9,000. Cleaning again for 23, indicated there. Postage for 13. You have motor vehicle expense. So this one was for delivery van, 5,000 mile services, so it's a motor expense for 43,000. You have petrol, the same, 18, it's a motor expense. Then we have cleaning for 21,000, postage for 5, and petrol, motor expense. So we are going to add all this. So we total them. We are going to have 77 on cleaning, 97 on expense, postage 41, stationery 26, and traveling 45. So the total of this will end up to 286. So the cash that we utilized during that period, it was 286, and we need to get a balance carried downward for 300. So this is what I was talking about, the interest system. So this is a system of accounting which operates on a simple principle that the cashier shall be refunded the exact amount spent on the expense during a particular financial period. So we need to be refunded the 286, so that our receipts or the cash should total to 300, or what we receive from the cashier as a petty fruit. So our reimbursement on the same amount will be 286, which would bring back the amount to the cash fruit at the beginning of the period, which will be 300. So that is our petty cash book illustration and how to do it. So you can go ahead and look at the general journal or the journal proper. So for the general journal, we call it, you can use the word journal or the diary, which means daily. So a journal is a day-to-day record. So for this, it is showing for each transaction the debit and credit entry in a specific ledger. So we do this is in a daily routine. So like here, the form of a journal to record a purchase for a motor vehicle. It should look like this. So you have a motor vehicle for you. We have a debit and credit from owns motors. So we can, for our narration, we can talk about being purchase of van on credit from owns motors. So that is our general journal. So we have to indicate it on a daily basis. So double entry and the ledger, you can also look at that. So increase in assets, expense, and owner's drawing account, we indicate them on the debit side on our double entry. And increase in liability, revenue, and owner's capital account, we indicate them on the credit sides. So that is the double entry rule. So for the asset, expense, and owner drawings, they are on the left. Liability, revenue, owner's capital, they are on the right. So we use the T format. So the ledger. So a ledger is a classified record transactions. So we classify records of all transactions, and we have two types of ledger accounts. We have the personal accounts and impersonal accounts. For the personal accounts, are those opened by the trader with various persons with whom he transacts business, the trader's own capital account and drawings account being included. So those are the personal accounts. For impersonal, we have it is subdivided into real accounts and nominal accounts. For real, it indicates all accounts which record transaction in property. But for nominal accounts, records revenue and gains and losses which have been taken into account in computing the profit or loss which the business has made. So those are the two different. For real accounts, transaction in properties. For nominal accounts, transactions in revenue, gains, losses which have taken into account. So we can talk about an example of a sale ledger. So for the sale ledger, let's look at these illustrations. So you are to enter up the sale journal from the following details, post the items to the relevant accounts in the sales ledger, and then show the transfer to the sale account in the general ledger. So you have to do three things here. You have to do the sale journal, then the sale ledgers, and then the general ledger. So we start with the details. 2010 on March 1. We have the credit sales, J. Amondi for shilling 1870. Date 3, we have credit sale to G. Achieng 1660. March 6, credit sale to V. Charles 120. March 10, credit sale to J. Amondi 550. Then you have 17, credit sale to F. Mwangi. 19, credit sale to U. Akech 660. 27, credit sale to V. Sala 280. And March that one, credit sale to Kate 780. So first we are being told you are to enter up the sale journal. So we enter the sale journal. As we discussed, we have the title, date, details for you, and the amount. You can also have the invoice numbers here. So we start with the March 1. We have the date, March 1, J. Amondi credit sale, and the amount. We are going to indicate again for Achieng 1660. March 3, then we have Charles March 6 of 120. March 10, Amondi again 550. F. Mwangi 2890. U. Akech for 660. V. Sala for 280 and L. Kate for 780. Then we total them 8,810 that you shall transfer to the general ledger or the sale accounts. So then we also been told post the item on relevant account in the sale ledger. So we are going to create sale ledger of each. So for Monday account, we are going to debit all this. So the sales we debit. So Monday has two accounts, two transactions for March 1 and March 10. So we indicate both sales 1870 and 550. Then we go to Achieng. Did on sales on credit sale on March 3. So we debit account. Charles, we're also going to debit on the sale for March 6 for 120. Mwangi account, we debit the sales for 28.90. Brackets. A sale ledger we debit the sales for 660. Account March 31st for L-kit 780. You can see on the debit side it shall be blank. We leave it like that because they never did any transactions. So those are the sale ledgers. So now we transfer the total to the general ledger account. So the sale account, for the general ledger in a sale account, we also have to have these headings, the date, the details, that is on the left. On the right we have the dates, the details, and the shillings or the amount. So we always credit on the sale accounts. So we credit. So on March 1, we had Omondi. So here you have J Omondi for 1870. So you are supposed to write Omondi here. So J Omondi for 1870. On March 3, you have Jia Chien for 1660. Then you have V Charles for shilling 120. Credit that. 10. Again you have J Omondi. Then you have March 17, F Mwangi. And then March 19, you have U Akech for 660. Then we have the V Sala for 280. And finally have L Kit for 780. So the total of this is 18. It is 8,810. So 8810. As you can see from our sale journal, that is the transfer or the total that we are making to the sale account. So we have 8,810. So any question on the ledgers, the sale ledger? So for the purchase ledger, it's all the same, but now you need to credit to credit all the purchase on the right hand side, and then on the purchase account you are going to debit. So it's as simple as that. So let's go to finally the trial balance. I'd like also we talk about the trial balance in our discussion. So the total debit balance should agree with the total of all credit balance. So the debit and the credit. So for the debit you have the expense and the assets. Credit you have the revenue, liability, and the equity. So an example we have here, this is the format. So we need to write the title. We have the trial balance as at that 1st December and the year. So for the rent income, so the revenue, so we credit. We have debtors, so all those who owe us, we are going to debit them. So we are going to debit you, Francis, all the expense, the motor vehicle, the bank, the purchases, the wages, all that. For the capital, equity, we credit creditors, liabilities, we also credit that. Then assets, furnitures, we debit. Sales revenue, we credit. cash in hand, assets, creditors, we credit, expense, stationaries, all those we are going to return inwards, we debit, return outwards, we credit. The drawings, assets, expense, and the drawings, we debit them. So then you get the total for debit and total for credit. So the total debit balance should also be equal with the total credit. Yes. So all this we are going to help you. So I think we have come to the end of our reading today. So if you have any questions, please write them on the comment. And also you can also ask for personalized teaching. I'll be glad to help, or more explanation on the any subtopic that you have not understood. So thank you. See you. Come back. Today I'd like to talk about the property, plant and equipment, accounting for them. So these assets, they are intangibles. So if they are intangibles, what are they? So we can define them as they are assets that are held for use in the production of supplies of goods or services, for rental to others, or for administrative purposes. Also, they are expected to be used during more than one period. Also, the cost of item of property, plant and equipment shall be recognized as an asset if and only if 1. It is probable that future economic benefits associated with the item will flow to the entity, and as well the cost of the item can be measured reliably. So those are all what we can talk about the tangible items, the assets, all its definitions. So let's continue with the definition. We have the measurement at recognition. So if you want to recognize this asset, so its measurement at recognition, we define it as an item of property, plant and equipment that qualifies for recognition as an asset shall be measured at its cost. It have to be measured at its cost. Then you have the measurement after recognition. An entity shall choose either the cost model or the revaluation model as it is accounting policy, and shall apply that policy to an entire class of property, plant and equipment. So what about cost model that we have seen above after recognition? So after recognition as an asset, an item of property, plant and equipment shall be carried at its cost, less any accumulated depreciation and any accumulated impairment losses. So that is what we call cost model, or what we define cost model. What about revaluation model, also recognized after recognition? The measurement after recognitions. So this one, revaluation after recognition as an asset, an item of property, plant and equipment whose fair value can be measured reliably shall be carried at a revalued amount, being its fair value at the date of the revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. So that is revaluation model. Then we have residual value of an asset. Is the estimated amount that an entity would currently obtain from disposal of the asset after deducting the estimated cost of disposal, if the asset were already of the age and in the condition expected at the end of its useful life. I hope we are together. Please write some few notes on this. You can as well screenshot as we go on, so that we be on the same track. Let's look what is depreciation. Is the systematic allocation of the depreciable amount of an asset over its useful life, or is the diminution in the value of asset due to wear and tear or due to just passage of time? So that is depreciation. So what are the factors that cause depreciation? So we have various factors that can cause depreciation, but we are going to look at a few. So one that causes depreciation, we have wear and tear due to actual use. So a machine can wear. You have the efflux of time or the mere passage of time. Then obsolescence, this is outdated, or a new invention or a permanent change in demand may render the asset useless. We also have the accidents or falling market prices. So these are the factors which will obviously cause the depreciation to happen. So I'll give you a few minutes. Let's continue. The basic factors in depreciation calculation. So in order to calculate the depreciation, so you have the basic factors that we have to consider. One is the cost of the assets. So the cost of the asset must be considered. Then the estimated residual or scrap value at the end of its life. Then the estimated number of years of its life. They have to be considered. And these are years which is likely to be used by the farm. So they are the exact years of its useful life being used by the farm. What are the objectives of providing depreciation? So what are these objectives that will help in providing depreciation? First, we have to ascertain true value of asset and financial position. So that is one of the objectives of providing depreciation. So it is ascertain the true value. Then make provision for replacement of honored assets. So assets have to be replaced. To calculate correct amount of profit or loss. So the profit and loss calculation, we have to show the expense or cost incurred to earn revenue must be charged to the profit and loss account for the purpose of correct computation of profit. Then you have to compute cost of production. So we have to compute the cost of productions. Comply with the legal provisions. So we have to comply with the legal provisions as well as to avail of tax benefits. So it will show more profits if the provision is not charged on assets. So the income statement can be overstated. Let's go ahead and look at the methods of providing depreciations. So we have various methods of providing this depreciation. So we shall look at a few. So first, we have what we call fixed percentage on original cost, or fixed installment, or mostly it is known as the straight line method. So this one is a suitable percentage of original cost is written off the asset every year. So a suitable percentage, it is constant, it is written off every year. So its formula, it is cost minus the estimated scrap value all over the estimated life of that asset. Then you have the second one called fixed percentage on diminishing balance, or the reducing balance method. Here, a rate or the percentage of depreciation is fixed, but it applies to the value at which the assets start in the books in the beginning of the year. So the balance at every beginning of the year, it is the one that is going to be used to calculate the depreciation. Then we have another one called sum of the digits method. So the sum of the digits method, the formula, it is the remaining life of the assets, including the current year. You divide by the sums of all the year, sum of all the life of the asset in year, then you multiply by the cost of the assets. So you are going to get the sum of the digits method. Then you have the annuity method. This one takes into account the interest lost on the acquisition of the assets. So this one involves the interest lost. Then you have revaluation method. It is used only in case of small items like cattle or loose tool, where it may be too much to maintain an account of each single item. We have depletion method. So this one is used in case of mines, quarries, or an estimate of total quantity of output likely to be available should be available. So it is used to calculate the depreciation of mines, where we have all the total output. Then you have the machine hour rate method. Instead of the usual method of estimating the life of machine in years, it is estimated in hours. Here we estimate in hours. Then we have the repair provision method. So to the cost of the asset, we raise its estimated scrap value. The amount expected to be spent on its repair and maintenance throughout its life should be added, and the sum then divided by its estimated life. So here we are going to get the cost of the asset, we raise the scrap value, then the amount expected of that repair throughout its life should be added, and the sum then divided by its estimated life. And then we have revaluation of non-current assets. We had repair provision method. The next one is insurance policy method. So this one refers to the system that insurance company used for handling, issuing and managing insurance policy. Then the last one, it is depreciation fund method. A fixed amount is debited every year to depreciation account or profit and loss account. It is credited to depreciation fund account instead of asset account. So the asset is shown at its original cost in the books in every year. So here we are dealing with the depreciation account, which is credited to the depreciation fund account instead of the asset accounts. Wow. That is what all about the methods that you can use in calculating depreciation. So let's look at the revaluation of non-current assets. So non-current assets are held by an enterprise for the purpose of producing goods or rendering services, as opposed to being held for resale, the normal course of the business. So the purpose of revaluation is to bring into the books the fair value of the fixed assets. We are together. If you have any questions regarding any of the subtopic, please comment below and we are going to look at it. So we also have the reasons for revaluations. So why do we do revaluations? First is to show the true rate of return on capital employed on these non-current assets. Then to show conserve adequate fund in the business for replacement of fixed asset at the end of their useful lives. So we have to conserve adequate funds. Another one is to show the fair market value of assets which have considerably appreciated since their purchase, such as land and buildings. Also, to negotiate fair price for the assets of the company before merger with the acquisition by another company. Another reason is to enable proper internal reconstruction and external reconstructions. Another reason is to issue shares to existing shareholders. Also, to get a fair market value of assets in case of sale and leaseback transactions. Also, when the company intends to take a loan from the bank's financial institution by mortgaging its fixed assets. We also have sales of an individual asset of group of assets. In financial firms, revaluation reserves are required for regulatory reasons. Also, to decrease the leverage ratio, the ratio of debt to equity. So that is all about revaluation. Now let's look at the property, plant and equipment movement schedule. So the property, plant and equipment schedule is a summary report on the balance and transaction of the assets and provision for depreciation account as per the requirements of IAS 16 to be reported in the published accounts of company. So that is all about the property, plant and equipment. So the format is as follows. So we have the title, the property, plant and equipment movement schedule format. So we always have the cost variation, so and the non-current assets. So we have the freehold property, leasehold property, plant and machinery, features, furniture and fittings, as well as the total. So we start with the balance at the year. So we can estimate that is 1st January 001. So all the balances of all the properties. So for the leasehold, we can have the long lease and the short lease. Then all the additions, any addition that we did and its total. All the revaluation gains, all the revaluation amount we did that year. Reclassifications, all we did, all the disposals, and then balances at that 1st December of that year. Then below we are going to discuss on the depreciation or the amortizations. We have the intangibles. So the balance as at January that year, let's assume it is 2010. So we can have all the balances, then charge for the year. So we are going to calculate that so that we bring all the amount for the charge for the year here. Then we have the revaluations and also the eliminated on disposals. So all the elimination on disposals. Then the balance at 31st December of that year, 01, and also we have the net book value for the previous year and the current year. So we are going to get all that. So in order to understand this, we shall tackle a question and we see how we can handle this. So this is the formula, and necessarily not all the cost variations that we put. Some we skip. So during the reclassification, there is where some of the non-current assets are transferred into different classes, e.g. some properties held under long leases over 50 years would be transferred to short leases classes when their term becomes less than 50 years. So this is all about the reclassifications. So we have the long leases, the property are transferred from, if they have 50 years and more, to short leases less than 50 years. So that is what we call the reclassifications. So let's continue. Then we can also talk about the control accounts or the total accounts. So the control, they control a section of the ledgers. So they contain totals of posting to the individual or personal account which it is controlling. So those are the what we can say about the total accounts. So let's start with the first one, the sale ledger control account. So this one can also be known as trade receivable control account or total debtors account. So it contains all entries for the total of all items posted to the individual debtors account. Okay, its format is as shown. So on the debits on the left hand side, you have the balance brought down of the total debit. Then we shall also have, so this total debit, the balance brought down, it's the total debit balance from the previous period. Then on the left side, we also have the final credit sale for the period. So the final credit sale, we also have the refunds to customers, bad debts recovered, and also dishonored check. So those are the things that we put on the left hand side. On the right hand side, credit side, so we have all the total credit balance of sale ledger brought forward. So the total credit, then you have the cash received from debtors. You also have check received from debtors, total return inwards, discount allowed, bad debtors written off, cash received from bad debts recovered, allowance to customers, purchases ledger contra. All these are on the credit. So we shall have the total debit balance carried down, and also on the left side we shall also have the total credit balance carried down. So they shall be like that. So this is a format. So we shall also have to handle a question so that we shall get all there to understand this. So let's look at the other one. It is known as the purchase ledger control account. So this one can also be known as trade creditors control account or the total creditors account. So this one contains all the entries for the total or item posted to the individual creditors account. So this one is individual creditor accounts. So the formats is also as shown on the left hand side. How you have the debit, we shall start with the balance brought down for the total debit balance from the previous period. So this one will also start from the previous period. Then you have the total checks paid to creditors, total cash paid to creditors, total cash discount received, allowance by suppliers, sale ledgers contra, and total return outwards. So on the right hand, we have on the credit side, we have the total credit balance of the purchase ledger brought forward. Then you have the total credit purchase from journal, also referred from suppliers. So on the right hand side, we are going to get the total debit balance carried down. On the left hand, total credit balance carried down. So this is a format. We also going to handle an example so that we get all the information. I hope everyone is cool and we are together. Please ask any question on the comments and I shall come back to you. So let's continue. Then let's look at reasons for maintaining control accounts. Why do we maintain these control accounts? So first is to ensure arithmetic check on the accounting records. So you have to ensure the arithmetic check. Then in case of incomplete records, you'll have to understand on that. Then provides a quick figure for total balance as at a given time to be reflected in the statement of financial position as debtors and creditors respectively. It also helps on that. Also help in detect and prevent fraud in the suppliers and the customer accounts. Also facilitate allocation of duties among the debtors and creditors handling staff. Let's look now at the cash book and bank reconciliation statements. So the cash book for cash at bank records all the transaction taking place at the bank. That is the movement of the account held with the bank. So this one, items appearing in the cash book are not reflected in the bank statement. We have to unpresented checks. So these are checks issued by the firm for payment to the creditors or to other suppliers but have not been presented to the firm's bank for payment. Uncredited deposits or checks. These are checks received from the customers and other sources for which the firm has bank but the bank has not yet availed the funds by crediting the firm's account. So those are the two that we usually use to help us in the reconciliations. So what are errors made in the cash book? So we have also errors that can be made in the cash book. So we can have the payments over or understatement. Then deposits can be also over or understated. Then we also have deposits and payment misposted. Then overstating and undercasting the balance carried down in the cash book. All those can be errors found in the cash book. So let's look at the bank reconciliation items. So we have various. We can check on the deposits interest. So this one, so mostly company will make frequent cash deposits. So company we have to record to show one or more deposits. So this one will also be shown in the reconciliations because they are frequently deposits made by the company, which will not appear on the bank statement maybe. Then you also have outstanding checks. So the outstanding checks also will be part of the reconciliation item. Then you also have automatic withdrawal and deposits. You have to check on that because company may authorize a bank to automatically transfer funds into or out of their account. Then you also have the interest and bank services charges, which can be banks are required to pay maybe to the customer to pay monthly account fee, check printing fee, safe deposit box, rental fees and other fees. All those have to be catered for. NSF, not sufficient fund checks. So this one, they have also to be recorded because a check previously recorded as part of the deposit may bounce because there are not sufficient funds in the issuer's checking account. You can also have the errors. So those are the reconciliation items. So let's look at the format. We start with the bank reconciliation statement as at that year or that period of time. Then we have the balance at bank as per cash book updated. So we have to update that the balance on the cash book. Then we have to add the presented checks, unpresented checks, errors on bank statements. So this one, they are going to effect on the increase on the balance at bank. So this is the errors which are affecting the increase on the balance at bank. So we add that. Then we less uncredited deposits. Then we also less the errors on bank statements. These are errors which affect or effect on decreasing the balance at bank. So that is the first format. We can also have the second format whereby instead of adding unpresented check, we start with the less uncredited deposits, errors on bank statement, then we come add the unpresented checks and errors of the bank statements. So you can put these two in two ways. So you can start with this upper part of unpresented checks, or you can also start with the uncredited deposit. You add them and then you raise the other part. So that is all about the bank reconciliation format. And mind you, when you take one format, you have to understand it properly, because in here where we have the unpresented checks, so if you start with this format as shown, you have to go all the way to the end with it. If it's the second option, you have to add the uncredited deposits and errors on banks statement, then you less the unpresented checks and errors on bank statement all the way to the end. So you don't need to mix them. You have to take a group and another group separately. So you can utilize this format or the one that I've explained, whereby you start with the adding the uncredited deposits and erasing the unpresented checks and the errors of the bank statements. So let's continue. So I want to discuss about the overdraft. So for the overdraft, we can talk about this is the negative bank balance. So this one, an overdraft occurs when money is withdrawn from the bank account and the available balance goes to below zero. That's why I'm talking about the negative balance. So which are the reasons for overdraft? Intentional short-term loans. So that is also another cause. Then failure to maintain an accurate account register either by the firm. Then ATM overdraft, you also have that. Temporary deposit holds. This one, a deposit made to the account can be placed on hold by the bank. We also have the unexpected electronic withdrawals. Then we also have authorization holds. Then the bank fees, and as well as paying the fraud. So where the account holders make a debit while insufficient funds are present in the accounting, believing that they will be able to make some deposits at the end before the debits clears, and they do not do so. So those are the reasons for the overdrafts. We also have the return check deposits. So account holder deposits a check or money order, and the deposited item is returned due to non-sufficient fund, or either closed account or being discovered to be counterfeit, stolen, altered, forged, or that. We also have another reason for overdraft: intentional fraud. Then we also have the bank errors, victimizations. The account may have been a target for identity theft. Then we also have the intraday overdraft. This one occurs when the debit in the customer account resulting in an overdraft, which is then covered by a credit that posts to the account during the same business day. So those are the reasons for overdraft account. So for now, I think now we shall look at the some of the examples so that you can be able to understand. So anybody having any questions as we continue? So the first example that you can look, it is about the accounting treatment and depreciation. I've discussed that, but I'd like to look at the one example. So when we are accounting for depreciation, there is this account that we introduce called provision for depreciation. So we have to debit the P&L account and we credit the provision for depreciation account. So that is another account that we introduce during depreciation. So let's look at the illustrations. So a company start a business on 1st January 1999 and the financial year ending being 31st December. Here you are to show the plant account, provision for depreciation account, and then the balance sheet extract for each year, 99, 2000, 2001, and 22. Then the machinery bought was on January 99, we have the for 8,000, 2,000 we bought 2, each for 5,000 on 1st July. Then 1st October another one for 6,000, and 201 we don't have, 202 another one for 2,000. So we are told that depreciation is at a rate of 10% per annum. We use the straight line method. Rand being depreciated for each proportion for the year. So this is the straight line method that we are going to use. So for solutions, so I'd like you to take a snippet for the questions so that you can be able to move together. So I think you have done that. So let's find the solutions. So we are being told to prepare the plant account. So let's start with the plant account. So this is the plant account. We are going to have two sides, the debit and the credit. So on our cash book in 1999, we are going to show on 1st January we bought a plant costing 8,000. So on December we shall credit that the balance carried down of 8,000. I think we are together. Then on 2,000 on 1st January we shall the balance brought down on our cash book is 8,000 from the previous year. Then on 1st July we bought 2 plants, so on our cash book we shall write 10,000. Then on 1st October we also bought another one for 6,000, so the total will be 24,000. So this is what we are going to carry down to that 1st December. Then on 2/1 we did not have to buy anything, so the balance brought down from the previous year shall be 24,000. So this is 1st January. And then we also have the balance carried down will be that 1st December. So that is 24,000 shall be the same. On 2/2, the 1st January, we shall bring what we carried down from the previous year. So that is 24,000. Then we also on 1st April, we bought another one for 2,000. So that is 26,000. At the end of the year, we shall have carried down 26,000. So this is the format or what we are supposed to do for plant account recognitions. You can take a screenshot. Let's go now to the second thing. We are asked to calculate the provision for depreciation account. So you have to show that. So before that, let's calculate the depreciations. So let me show you. So we are going to calculate the depreciation, which will help us in providing the provision for depreciation of account. So we shall start with the first year. We have been told that the depreciation rate is 10%. So 1999 will be 8,000, 10 over 100. It was bought on 1st January, so it is under 12-month period. So 12 over 12. So that one is going to give us 800. So the accumulated depreciation will be 800 for that year. So then we go to 2000. The same plant was there in 2000. So we calculate another depreciation for that account, for that plant, for 8,000, the 10% for the next 12 months. So it will be 8,000. Then on 1st July, we bought 2 plant, 5,000 each, for that is 10,000. So the period was 6 months since it was bought on July. So it will give us 500. Then we also bought another one on 1st October, which is going to give us 3 months. So we get 6 months of 10%. In 3 months, 150. So we add the depreciation here. We are going to get 1,450 as the accumulated depreciation. On 2001, we saw it is we carried down 24,000 for all the items. So we calculate the depreciation using the whole 12 month. So we are going to get 2,400, and also in 202 we shall also calculate the balance brought down for 24,000 for the whole year, which is 2,400, and also the 2,000 which we bought and planned from 1st April, so that is 9 months. So we shall get 150. We add to get 2550. So the total accumulated depreciation will be 7,200. So this is all about the calculated depreciation. So any questions as we continue, please indicate in the comments. So you can like that as well as get a screenshot as we continue. So that now we get to show the provision for depreciation account. So for provision of depreciation account, we are going to use what we have calculated in the depreciation amount. So we shall have two sides. We call that on the left hand side the debits and the credit. So we shall introduce the income statement on the P&L. So we saw that we were to debit the P&L and also credit the provision of depreciation. So in 1999, the balance carried down is 800, as we have seen from accumulated depreciation. So on the that 1st December, we debit that 800, and as well we put we credit on the income statement 800. Then on 2000, that 1st December, balance carried down will be 2250, because on 1st January we brought down the 800. We are going to credit this side. So and the income statement we saw on our calculation for depreciation was 1450. So when we add both of them, we are going to get 2250, which is the balance carried down on 2000. So as well on 21, the balance brought down will be now the 2250. As well, the accumulated depreciation was 2,400, which we are going to state it on the income statement. So total 4650. That is the balance carried down on our debit side. In 202, the balance brought down will be 4650 plus the income statement, which we saw was after calculating, which will be credited on 2550. So the balance carried down will be, starting these two, will be 7200. So they are going to be equal. So this is the provision for depreciation. You have to show the income statements as well as the provision for depreciation. Since we were debiting the income statement, when we come to provision of depreciation, we are going to credit it. Okay, any question from that? Let's continue. So our last thing that we are being asked is to provide the balance sheet extract for the year 1999 all the way to 202. So the balance extract. So these are non-current assets. So we are going to write the non-current asset. We have the cost, their cost, actual cost, accumulated depreciation, and the net book value after we have subtracted this. So in 1999, the plant we bought was for 8,000. 2000, the plant accumulated the cost, the total cost was 24,000. 201, we never bought anything, the total cost was 24,000, and as well as in 202, the total cost was 26,000. So this, we are getting this from the plant account. If you can remember the plant account that we generated in our first question, this one. So these are the plant account or the cost that we are looking. Then we are going to get the cost from the accumulated depreciation. Accumulated depreciation, we are going to get it from the calculation that we have done from the calculating the depreciations. So you have to no, the accumulated depreciation, we are going to get them from the provision of depreciation. I'm sorry for that. So as you can see, the depreciations account or the provision for depreciation, we have 800, 2250, we have 46, and we have as well as 72. So since our cost is their total, also the accumulated depreciation need to be also in total form. So in 1999, our total was 800. So the accumulated depreciation is 800. When you subtract, you get 72. In 201, total 24. Total accumulated 2250, which give us 21,750. In 201, we have 24,000. Our total carried down was 4650. So you subtract, get 19,350. The last one was 26,000, and total was 7,200. When you subtract, you get 18,800. So this is the balance sheet extract that we are going to do, or that is what you are supposed to do. So you can get some note on this as we continue. So a minute on that. So let's continue. Another thing that I needed us to look is the property, plant, and equipment movement schedule. I gave you the format, but I'll now we look at the illustration. So we have the chief accountant of Jivunia Limited has encountered difficulties while accounting for fixed asset and the related depreciation in the company's draft account for the year ended 30/1. He has decided to seek your professional advice and presented the following balance of fixed assets at May 2010. So we have the acquisition cost, accumulated depreciation and depreciation rates. So furniture, trucks, plant machinery, land and buildings, their cost, accumulated and the depreciation rates. Additional information. It is the company policy to write off cost of the asset using above percentage on costs. Then depreciation is fully charged in the year of acquisition and none in the year of disposal. Then you have a 3-year-old machine acquired for 187,500 or sold for 15,750. It has been decided to adjust and charge depreciation on buildings at 4% in 5 years. I used the delivery truck purchased 3 years ago for 248. 250 was traded in during the year at a value of 157,500 in part exchange for the new delivery truck costing 450. Large building and machinery were acquired for 1,350,000 from a company that went out of business. At the time of acquisition, 90,000 was paid to have the asset revalued by a professional qualified valuer. The revaluation indicates the foreign market values. You have the land 900, buildings, machinery 300. So required a schedule of movement of fixed asset as required by the chief accountant for inclusion in the company accounts for the year ended 30 April. So getting the screenshot for this, we are going to have to do, and we do the plant equipment movement schedule. So we have, there are 3. So we have the cost variation. We have 3 non-current asset. We have the large building and machinery, and then we are going to combine them. Then we have the furniture on its sides, the motor vehicle, and then the totals. So we are going to start with the balance as at May 1st, 2010. So the balance as that was 13,007,500 for large building and machinery when you add all of them. So for furniture, we have 900. Its cost, motor vehicle, 3,525,000. And so the total, excuse for that, for the total, we have 17,512,500. And then we have the additions. We can start with the additions where we are being told that large building and machinery were acquired for 1,350,000, so we shall like that. Then we also have the motor vehicle. A new truck was obtained for 450. So those are the new additions. The total become 1.8. Then we also have the revaluation gains. So to calculate this, we are told that the large building and machinery were acquired for 1,350. 1,350,000. But as you can see above, after the revaluation, we had 900 for large buildings, 600, and machinery and 300. When you add this, become 1,800,000. So you have to subtract the total of from 1,350,000 of what we had acquired. So the revaluation gain that we are going to get, it is 450. We don't have any other revaluation gain for the other two. Then we also have the disposal. A 3-year-old machine acquired for 187,500 was sold for 15. So we are going to dispose that. And then also motor vehicle that was purchased 3 years ago for 248,250. so we are also going to subtract that. So we also have to get their totals. So balance at 30 April 2011 will be, beyond this, to get 14,700,000. Here you have 9,307,026 and 750, as well as the total of 19 million. So we go to the next part of depreciation and amortizations. So here we are going to start with the balance carried on as of 1st May 2010. So in our question, we are being told that the balance carried on for the land, building and machinery, when you add all of them, we get 4,755,000. Then you also have for furniture, which is 300,000, and also you have for truck or the motor, which is 1,470,000. So these are the accumulated depreciations. We can call them the balance, since we are looking at the depreciation. So these are the balance on that date. So we are going to calculate the charge for the year. So the charge for the year, this we have to work out elsewhere, so that will bring the amount on the list. So I can show you how I have done for each of one of them. So we are going to start with the for the lad, we are being told that it has a depreciation rates for nail. So we are not going to calculate the depreciation for lad. So we are going to calculate for building, machinery, furniture and motor vehicles. So let me show you the calculation or the workings. So these are all the workings that I have done. So we start the depreciation on the furniture, which we had the 900. So the acquisition cost 900,000. So the rate is 12.5. So we get 112,500. Then we have the depreciation on disposal. Disposed. So we are told that a truck purchased for 248,250 was disposed was purchased 3 years ago. But we are told that depreciation is free charge in the year of acquisition and none in the year of disposal. So for the 3 years, we subtract the 1 year that was for disposal. So we are going to calculate it for 2 years. So depreciation rates, it is 25% times the cost times the 2 years. We get 124. So that is for the depreciation on disposed delivery truck. Then we also have another calculation for the motor vehicle. So the motor vehicle, we are going to get its cost here. So this is the balance after we have the total. We have added the new truck and as well as disposed. So this is the amount that we are going to use to calculate the depreciation, which the depreciation rate is 25%. So we are going to get 931,557.50. So that is for the motor vehicle. Then for the buildings, we are going to calculate for two scenarios. First, we are going to calculate at 4%, the one that we have been given, because we are told it has been decided to adjust and charge depreciation in buildings at 4% for 5 years. So since we are not calculating the year of disposal, so we are going to calculate at 4 years within the 5 years. So the 4 years for the total for building was 2,925,000. So times 4%, times 4 years, we get 468. Then, but in the question, we are given the depreciation rates was 2.5. So we calculate the same with the 2.5 rates, we get 295, 500. So in order to get the correct amount, we have to subtract the adjustment of 4% and the one that we are given for 2.5. We get 175, 500. Then we are also going to calculate now the total amount for the building. We had 2,925,000. Then we also acquired for the building that we acquired had a value of 600,000. So we add both times the 4%. So we get this 141,000 for that year, since this one was for the year acquired. So we shall add 141,000, 175,500. And since we also indicate machinery, we have to calculate the machinery costs or depreciation charge for the year will be its cost or the additions, then you subtract all the disposals. So the machinery was 7,387,500. We added we acquired a machinery for 300,000. We had disposed that one for 187. That is 3-year-old machine, 500. So our total was 7,500,000. So we multiply by a depreciation rate, which is 10%, we get 750,000. So, and finally, we also have to calculate the depreciation of disposed machine. So 10% of the depreciation of disposed machine was 187,500. So, and it was for a 3-year-old machine acquired. Since we are not calculating the year of disposal, we are going to multiply by 2 for the year of the 2 years, which we shall get that 7,500. So for the large building and machinery, we are going to add 750, 175, 500, and 141,000. So we get our charge for the year is 1,066,500. For the furniture, we got it is 112. For the truck or the vehicle, we got it is 901,000 and 687.50. So the total will be 2,110,000. Then eliminated on disposal, we have two. So we have the truck and the machinery. For the truck disposal, we got for the 2 years it is 124. So we have that one for the 124. And for the machinery, we have calculated it after disposing the 187 for the 2 years, get 37. So that is all what we are supposed to do. So after we got this, so we need to add this. We add these two, subtract that, we get balance as at 30 April 2011. Now we are going to get the 5 million. The same for the furniture, for the motor vehicle, and then the total amount, we are going to get that. So that is balance as at 30th April. What about now the net book value in the same year of the 30th April 2011? So we are going to get the balance as 30th April 2011. We subtract the depreciation of 5 million. So we get 8,916,000. We go to the furniture. So the 9 million, we subtract the 412,500, we get 487. The balance as at 13th April for motor vehicle, we subtract the 2 million, we get 1 million. Then the net book value as at 1st May 2010. So here we are going to get this, only the balance as at 1st May 2010, we subtract the depreciations. This one, the accumulated depreciation. So 30 minus 4 million, you are to get 8 million. 900 minus 900 minus this one 300, you get 600. 35 25 minus 1470, we get 25, as well as the total after you have added all that. So this is what we are supposed to do for that question on protect plant and equipment movement schedule. So I can give you a minute to check on the to look at the solution for that and get some screenshot, as well as take the for the workings. So we have the workings there, so I can give you a minute for each. Okay, another thing that I wanted to check, since I am given you the format, it is sale ledger control and purchase ledger control account. So let's look at the sale ledger. We shall start with the sale ledger, and then we do purchase ledger, but in the same question we shall tackle these two using this question. So we are told ABCD Limited maintains control accounts in its business record. The balance and transaction relating to the company controls account for the month of December 2014 are listed below. So we have the balances, sale ledger, their debit and credit, and purchase ledger, same debit and credit. Then we have the transaction during now the December. So we have the sales and credit, as you can see, and the amount. Purchase on credit, return inwards, outwards, bill of exchange payable, bill of exchange receivable, checks received from customers, checks paid to suppliers, cash paid to suppliers, bill payable dishonored, charged on bill payable dishonored, cash received from credit customer, bad debts written off, cash discount allowed, bill receivable dishonored, balance at December. We have the sale ledger, it's credit, and purchase ledger, it's debit. So the first thing we should do, it is get we are going to start with the sale ledger. So we are going to tick all the things that we are supposed to put on the sale ledger, and the rest shall be put on the purchase ledger. So let's go directly. So a minute so that you take the screenshot for that question. So you have done that. So you are told post the trade receivable and trade payables ledger control account for the month of December 2010 and derive the respective debit and credit closing balance on that for December 2010. So if you consider the format that I gave you, it will be very direct to understand what goes on the debit and what goes on the credit. For the sale ledger, shall have the title ABC Trade Receivable Ledger Control Account. So we are going to start with the balance brought down. As you can see from the question, from the sale ledger, we have the debit and the credit. So we are going to take the debit of 6,185,100. Then on the debit, you always have the credit sales and also the bill receivable dishonored. That is also on the debit sale. Another one that you can talk about is the referred to customers, dishonored checks, bad debt recovered. So those are on the debit. On the credit, we talk about the credit balance, total cash received, total check received, return inwards, cash discount allowed, bad debtors, written off, cash received, purchase ledger contra, all that. So if you have the format, everything will flow. So we are going to write the credit side on the debit side and bills receivable dishonored on the debit, since they are supposed to be written on that side. So on the balance brought down, we on our sale ledger, on our credit side, from the question you have been told it is 52,500. So you input the 52,500, you record that. Then all the things that are recorded on the credit side, we can start with the return inwards for 203, bill receivables, all the the income. So we have the bill receivables, checks received of 7 million, cash received, bad written off for 64, discounts allowed. So when you total this, you're going to get 14,769, 500. So on the credit side, it will be less. So that's why we are going to bring the balance carried down. So we are going to bring the balance carried down of 5,394,000. So this is the total debit balance carried down on our side, on our sale ledger. So I think that is enough. So any question on the sale ledger? The first thing to do is to understand the things to be recorded on the credit side and things to be recorded on the debit side. With that information, everything else will flow. So on our purchase ledger account, we're also going to have to do the same. So everything that was left will be on our purchase ledger. So ABC trade payables ledger account. So here we are going to start on the debit side and the credit side. As we understand, on the debit side, we have the total debit, total checks paid, cash discount received, say ledger contract, total returns, outwards, all those. On the credit side, we also have the credit balance, credit purchase, refunds from supplier, all that. So we are going to use that information to know what to record. So we start on the debit side. The balance brought down, as you can see from the question, we are told is for 16,500. On the credit side, it's for 4,200,000. So we input on the credit side that. So then on the debit, we have to indicate to record all these: the return outwards, the bills payable, checks paid, cash paid to suppliers. They are all on the debit. When you come to the credit, we have the credit purchase, bill dishonored, charges on the bill disbursed. So all these are the things required on the credit side. So after you have recorded that, you find the total on both sides. So on the credit side, we have 10,406,000 and 500. The same comes to the on the debit side. So the debit has less amount, so it will have the total credit balance to be brought on the debit side of 4,355,000. So this is the total credit balance, as we can see. So any question pertaining this purchase ledger account? Sirs, don't forget the balance carried down. It was on the purchase ledger where we had been told it was debit. So 23,500. You also need to indicate it. On the sale ledger, we did not have the debit, we only had the credit, which was supposed to be carried down. I think you have taken some notes on that. So any question, please consult me on the comments. So let's go to the final illustration. I'd like we talk about the bank reconciliation statements. As I gave you the format, so I'd like we look at the an example. So on July 10, Joseph Kahiga, sole trader, received his monthly bank statement for December 2005. The statement shown as follows. So you have the balance, debit, credit, the balance. So the balance was 186,200 on December 1. So as you can see, we have some checks on electricity. So those are the debits. You also have those one on the credits. So dividend, loan check, Jemima, all these are check. Miscellaneous, credit, the study in order. So if they are expense, you can see on the debits. So income, revenue, liability, they are on the credit side. So this is a bank statement. So I can give you a minute, get a screenshot on it so that you can be able to discuss on it. So bank charges, loan check, deposit, all that, as well as the balances for the bank. Then we also have the Joseph Kaiga cash book. So this is what he showed on his cash book. So balance brought down. We have this one on Solomon Kagai. On the credit side, we also have the electricity, the check number, and the amount. So a minute. So you can do that. You can also take a screenshot on that. Then we are asked, John required Joseph Kahiga's updated cash book as at that 1st December 2005 and Joseph Kahiga bank reconciliation statement as that 5 December 2005. So we are going to look at the amount. We are going to start with the cash book. So we look at the things that are on the cash book, but they are not on the bank statement. So we can start with the updated cash book. So the title, we are going to have Joseph Kahiga updated cash book as at 31st December 2005. So it's our T account. So from our cash book, the balance brought down was 179,300. So here, as you can see, there are things that are on the bank statement, but they are not on the cash book. So we are comparing things on the bank statement, but they are not in the cash book. So we have like dividend. Dividend is not on the cash book. So we are going to debit that since it's our income. So it is increasing our assets. So we debit that. Another thing that we can see that is on the bank statement, but it is also not in the cash book. We have the standing orders, bank charges, and also direct debit. So all these, they are liability. So we're going to credit them. So we credit that. So 3,200, bank charges for 1,800. You also have the direct. direct debit of 8,800. So the total or the balance figure will be, on the debit is 181,900, should be equal on the credit. So the balance figure, it is 168,100. So this is the updated cash book balance that we are going to bring on the bank reconciliations. So after noting that the things that are not on the cash book from the balance statement, so we have dedicated all of them. So then we are going now to calculate or to show our bank reconciliation statement as at that 1st December. So balance as per cash book updated. So this one, the one that we have brought forward, carried down. So it will be 168, 168, 100, 168, 1000. Let me confirm that. Okay, so the balance as per cash book updated, it is 168, 100. Then we have to either use the we have to format on bank reconciliation, the one that we earned and presented checks and the errors, and we erase uncredited checks and the errors, or we earned uncredited checks and errors, and we erase unpresented checks and errors from the banks. So let's start with this one for the unpresented checks. So we are going to look at those checks that have not been presented. So they are on the cash book, but they are not on the balance bank statement. So as you can see, we have some checks that are on the cash books. We have this one for Victor Kalanja, Steve Madia. So they are not on the bank statement. So those are the unpresented checks. So we write both of them and the amount. So the total will be 10,800. When we add that, get 178. Then we are going to less uncredited checks. So we have those checks that have not been credited by the bank. So we have one for Owen Duby and Water Oyubi. So this one on the debits, yeah, they show that they have not been credited by the bank. So we raise that. So the two will total to 23,200. After raising, you get 155,700. So this will be the balance at bank as per the bank statement. So that is all about the bank reconciliation. So you can get a minute, get some screenshot notes pertaining that. So that is all what you are supposed to do. And remember to take one format. You don't need to combine both format when calculating for reconciliation or showing the reconciliation format. So thank you. If you have any question, please comment below. I can also offer some personalized study. Just comment on the YouTube below and I'll reply, come back to you. So thank you and see you. Welcome back. Today I want to look at the types of accounting errors and their correction. So without wasting time, let's indulge. So we have errors of omission. So errors of omissions are errors that occurs when a transaction is completely omitted from the books of accounts. Then we have errors of principle. So when we enter a transaction in the long class of account but still observe the double entry. Then we have errors of commission. When the correct amount is entered but in the wrong personal account, though the account is in the same class of account. So that is the errors of commission. Then you have compensating errors, errors that cancel out each other. Then you have errors of original entry. So this one occurs when the original figure is incorrect and yet double entry is still observed using the incorrect figure. So I hope we are together up to there. Please write some short notes, screenshot as we continue. Any question, please write down on the comment below. Then you have errors of original entry. This one occurs when the original figure is incorrect and yet double entry is still observed using the incorrect figure. Then you have complete reversal of entries. So errors that occurs when the correct amount is posted in the correct account but in the wrong side of the account. Then you have transposition errors. It's a special type of an error of original entry which occurs when the wrong sequence of individual characters in a figure is entered. This can be 525 to be written as 552. So that is a transposition errors. So that is all about the errors in accounting errors and their correction. So let's look about the suspense account. So to this account, it is assigned the balance equal to the difference between the credit and debit side of the trial balance to ensure that the trial balance balance. Basically, all the errors affecting the balance of the trial balance necessitate the creation of the suspense accounts. So if you have any error in the trial balance, you have to create this suspense account. So that is all about the suspense account. So I would like we look at the examples so that we can understand more about this topic. So I have an instruction here for the types of accounting errors and their correction. So we shall start with it. So in our instruction we are told it shows the journal entries required to correct the following errors. Entries narrative must be shown. So we are told commission received 44,000 had been credited to rent receivable account. Bank charges of 3,850 had been debited to rent account. Then completely omitted from the books of account is payment of sundry expense by check 1150. Then you have purchase of fixtures 23,700 had been entered in the purchase account. Return inwards of 41,650 had been entered in the debit side of the return outward account. Then you have a loan from ASMU, shilling 25,000 had been entered in the credit side of the capital account. Then loan interest of 2,500 had been debited in the premises account. Goods taken for own use 1,250 had worth of 1,250 had been debited to purchase account and credit to drawing account. So these are the solutions. So before we go to the solution, please take the screenshot as well as you can make some few notes on the questions. So this is our question. We need to answer these errors and we are told to give narratives. So, or the narrations. So we start with number 1. We are told commissions received 44,000 had been credited to rent receivable account. So we have payment or revenue of commission. So it was credited to rent receivable account. So in order to correct this, we are going to debit, since it is increasing the revenue. So we are going to credit the commission since it is increasing the revenue, and then we debit the rent receivable account. So we are going to have debit rent receivable account. Then since it is increasing the revenue, commission received, so we are going to credit that. So we say correction of an error where commission received was credited to rent received. So with the same amount of money, 44,000. So we go to number 2. Number 2, we are told bank charges of 3,850 had been debited to rent account. So the charges they are being debited to the rent account. So what we are going to do here, we are going now to debit the expense. So we are going to debit the charges. So we debit the bank charges of 3,850, and then we credit the rent or the rent account which had been debited. So the bank charges of the expense we debit, and the rent account we credit. So to correct the wrong debit of bank charges in the rent account. So that is the narration. Hope we are moving together. So any question, please write below in the comment. We go to number 3. Completely omitted from the books of account is the payment of sundry expense by check, 1,150. So here we have a complete omissions. So we are going to debit the expense or the sundry expense, and then we credit the check or the bank. So we are going to debit the sundry expense and then debit the bank. So here we shall say with the same amount of money, 1150, then we shall narrate to record omitted payment of sundry expense. Then we go to number 4. Number 4 is purchase of fixtures. 23,700 had been entered in the purchase account. So we'd like to correct this. So the purchase, the fixtures had been entered in the purchase account instead of so instead of in the account, the fixtures account. So we are going to debit the fixtures and then credit the purchase account. So here with the same amount of 23,700 and 700. So we are going to debit the fixtures and then credit the purchase account. Then here is to correct the error of principle where purchase of fixed asset is treated as purchase. So that is the narration. We go to number 5. And remember we said that the error of principle it's when we enter a transaction in the wrong class of account but still observe the double entry. So we are putting the fixtures in the wrong account, in the wrong class of account of the purchase account. So that's why we are debiting and crediting the wrong account. Okay, so number 5. We are told that we have a return inward of shilling 41,650 had been entered in the debit side of the return outward account. So here we are going to correct the return inward had been entered in the debit side. So it is going to be credited where the return outwards should be debited. So return outwards we debit, where the return inwards we are going to credit of the same amount for 1,650. So here we are correcting the entry return inwards in the debit of return outward. So to correct entry return inwards in the debit of return outwards account. So let's continue. For number 6, we are told a loan from RSMU for 25,000 had been entered on the credit side capital account. So we want to correct this. So the SMU loan had been entered on the credit side of capital account. So the loan, we are going to debit the capital account of 25,000, and then we credit now the SMU account with 25,000. So this is to correctly record loan received from SMU. So we are going to do that because it had been credited on the side of capital account instead of being debited. Okay, so we have that. Then we have number 7. Loan interest of 2,500 had been debited in the premise account. So we have our own interest here. So it is debited on the premise account. So we are going to debit the loan interest account of 2,500, and then we credit the premise account. So since it has been debited, so to correctly record interest on loan. Okay, then we have number 8. Goods taken for own use, 1,250 had been debited to purchase account and credited to drawing accounts. So here it's what we introduced about the contract, because the goods are used for the use of the business. So goods taken for own use, these are good taken for own use. Yes, 1,250 had been debited to purchase account. So we are going to debit the drawing account. So we have the drawing account, which is 1,250, and then we credit the purchase account, which had been debited with the same amount. But remember, this we have two transactions taking place. So if you can check clearly here, there are two transactions taking place. So if this amount is debited instead of being credited on the same account, so if we take a single entry or a single credit entry, it will only just cancel the initial debit. So that's why we are multiplied by 2 here, because the second credit or the second debit entry will now enter the required credit entry. So instead of showing both two entries here, that's why we have multiplied by 2. So instead of showing them separately, the amount involved is doubled and the single entry made, but with the double values made. So we are going to multiply this by 2 to get 2,500. So, and also the same case scenario, the purchase account of 1,250 we multiply by 2. So here we have corrected we have cancelled the initial debit, and also we have corrected we have entered the correct entry of the credit. So that's why we are saying that if we take the goods for our own use, we have debited the purchase account and credited the drawing accounts. We are going to correct by, we debit now the drawing and we credit the purchase account, but we have to multiply by 2 to cancel the first scenario, the initial debit, and correct the the entries using the credit, or we enter the second credit entry. So that is all about the types accounting errors and their correction. Hope you have been taking some few notes or screenshotting. Okay, another thing that I wanted to check, it is about the suspense. You have this suspense account, so I'd like we take a question on it. So any question about the accounting error, please comment below. For suspend, we are told Martin is an accountant at Zabili Limited. During the year ended 30 June 2014, he prepared a trial balance which did not balance. He posted the difference in the suspense account. He then prepared the financial statement for the year ended June 30, 2014. The net profit of the company was 483. We shall use this one. So upon investigating, the foreign errors were later discovered. The total of the purchase day book had been undercast by 11,200,000. The total of the discount column on the debit side of the cash book amounting to 2,240,000 had been posted on the credit of discount received amount. Motor vehicles repair amounting to 8,512,000 had been posted on the motor vehicle account. Then a check of 4,000,000 received from Barnabas, Budi and data had been debited in the cash book, but no other entry had been made. Then the return outwards had been overcast by 5,600,000. So we are told we repair the journal entries to correct the errors, suspend account, and also the statement of corrected net profit. Okay, before I go on, please take some screenshots on that. So let's continue. So we have the solution. We are going to start with the journal entries. So we can start with the first one. We are being told the total purchase day book had been undercast. So the purchase, there was an undercast of 11,200. So we debit that. Then on the credit, we put the suspense account of the same amount. So here the total purchase had been understated. So the error now has been corrected when you use the suspense account like that. So we credit the suspense, we debit the purchase. Number 2, we are told the total of the discount column on the debit side of the cash book amounting to 2,240,000 had been posted on the credit amount of discount received amount. So here we are having the discount received amount which has been credited. So we are going to debit the discount received as well as the discount allowed of each amount of 2,240,000. Then we credit the suspend account. When we add both of these, we are going to get 4,480,000. So here the narration is discount allowed posted in discount received. Error now corrected. So we had the discount allowed had been posted in the discount received. Okay, we can continue. So we have number 3. We are told motor vehicle repairs amounting to 8,512,000 had been posted on motor vehicle account. So here the motor vehicles repairs were posted on the motor vehicle account. So we are going to debit the motor vehicle, the expense repairs, which were 8,512,000. Then we credit the motor vehicle account with the same amount. So here the motor vehicle repairs were posted on the motor vehicle account. So we have corrected them. So we debit the expense and then we credit the other account of motor vehicle. So then number 4, we have a check of 4,068,000 received from Barnabas Budi, and data had been debited in the cash book and there were no other entry. So since it has been debited in the cash book, we are going now to debit the suspense account, as well as credit now the Barnabas Goody account. Here we are saying that the receipt from data recorded in the ledger in error. So we have the error of omission now corrected. It was omitted since there were no any other entry. Okay, then we have the last one. Return outwards had been overcast by 5,600,000. So here we have we are going to debit the return outwards. So the return outward had been overcasted by 5,600,000. So the return outwards overcasted by 5,600. Then you have the credit suspense with the same amount. We credit with 5,600. So this one will correct the return outwards overcast. So it had been overcasted by 5,600 and that 600,000. So these are the entries that you are supposed to do, the journal entries. So you have now to create a suspense account of all these. So if you have taken some notes, let's create a suspense account. So the balance brought down, if you can check, not the balance brought down. Before we have to look at the accounts that we have put here. So we can start with the first. So we have the purchase for 11,200. Since we had debited purchases, so we are going to credit them for 11,200. Then we also have another suspense that need to be put in the suspense, the discount received. So we had a total of discount received and allowed. The total is 4,480, the suspense. So we credit that. Then we also have, we don't have a suspense there. We also have Barnabas. This one was recorded in there was an error of omission there. So we are not going to include it on the credit side. This shall be on the debit. Then we also have the return outwards. So this one 5,600. So on the debit side, we are going to debit the Barnabas data. So of 4,368. When we add this, we are going to get 21,290. So the balance figure shall be 69,12. So that is the balancing figure, or the balancing brought down in our suspense account. So if you want to understand this, you look where the suspense accounts are. So the suspense account, all of them, you have to show them in the suspense account. That's why we are not showing the for motor vehicles. And then we were told to statement of corrected net profit. So that is the last thing that we are going to do. So we have to show the statement of corrected net profit. There are some figure that I told you that we are going to use. This one, the net profit for the company was 483,840. So that will be our net profit before any adjustment. So we have to include it there at the top. Then from there, we now have to indicate all these overcast, undercast, anything that we have changed in our account, in our suspense account. So we start with the we have to subtract the purchases which were undercast. They were for 11,200. We subtract that. Then we also have the discount allowed and received. So you can combine them or you put them separately, 2240, 2240. Then we also have the motor vehicles, the repairs. which has been posted in the motor vehicle account. So you also have to subtract the motor vehicle expenses. And the last thing we have to do, we also have to separate or subtract the return outwards. So you also have the return outwards for 5,600. So the 3 zeros will cater in terms of millions. So 483 subtract this, you get 454,048. So this is our corrected net profit. So if you have any question, please don't hesitate, in the comment. I can also offer personalized teaching as well as answer your questions in the comments. Okay. Welcome back. Today I want to look about the financial statements of a sole trader. So we are going to look at the determination of gross profit or gross loss. So for gross profit is the difference between sales proceeds of a particular period and the cost of goods actually sold. So since the gross profits means the overall profit, no deduction of any sort is made, and that is general, administrative, or salary and distribution expenses made. Then the entries items that will appear in the income statement to ascertain this gross profit or loss, we have items to be debited and items to be credited. So for items to be debited, we are going to look at the opening stock. So this one will refer to the value of goods had at the end of a previous accounting year. Then we have the purchases. The purchases that you have made. We may have bought goods either on cash or on credit. Then we have the purchases returns or returns outward. Now we can due to some various reasons we might send back good to the suppliers. Then you have the direct expense. So these are expense incurred in connection with the purchases or the procurement of productions of goods. Okay, I hope we are together up to there. Let's continue to the items to be credited. So we shall start with the sales. So the sales of good in which business deals can include both cash and credit sales. Also we have the sale returns or the returns inwards. So goods are returned by the buyers for some reasons. Then we have the abnormal loss. This one we can refer to it as a abnormal loss due to stock, due to fire, theft, or accident. Then we also have the closing stock, which refer to the value of goods lying unsold at the end of any accounting year. So we are going to look at the trading account, its horizontal format and its vertical format. So let's start with the horizontal format. So this is the trading account horizontal format. So we shall start with the opening stock. So you have to create a T format. It looks like a T format. We have the debit side and the credit side. So we shall start with the opening stock and its value. We add the purchases. Then we also have we add the carriage inwards. And then we get the total. Then from there we can also we less the return outwards. We shall get the cost of stock available for sale. Then we less the closing stock. We get the cost of sales. Then on the right hand side you have the sales. we less the returns inward, you get the net sales. So that is how we are going to get the gross profit. The vertical format is still the same, but now you have to align them on the same side. So both these, the sales and the side of the opening stock, they have to be on the same side. So this is the mostly used format. So we shall have the sales, we less the return inwards, where we shall get the return, we shall get the net sale. Then now we add the opening stock, we have the purchases, we add the carriage inwards, then we have to raise the any return outwards, which shall help us to have the cost of stock available for sales. Then we less the closing stock, then we shall have now the cost of sales. So the cost of sale, we are deducting it from the net of sales so that you can get the gross profit. So that is all about the vertical format. So you can have some illustration here. We have an example. We are told from the following details, draw up a trading account of Mr. Karanja for the year ended 13 December 2010, which was his first year in business. So in his first year, Mr. Karanja, carriage inwards was 13,400, return outwards, you can see return inwards. You have the sales, purchases, and stock of good at that 1 December 2010. So this is the crossing stock. So the solution, we are going to utilize the vertical format. So we shall start with the sales less any return inwards, all that. So let's start. We have the sales. So the sales, we are told it's for 774,840. So we indicate it there. You have the rest. We less any return inwards, we are told is for 17,800, where we shall get 757,040. Then we have to raise the cost of sale, which include now the purchases of 666, 660. Any carriage inwards, we are told of 13,400. We have to raise any return outwards of 9,900. Crossing stock, we have been told is 149,790. So for the cost of sale, we are going to get 523.80. So we subtract from the net for the net sale. So the gross profit shall be 236,660. So that is the gross profit. Let's continue. So you have checked on the horizontal and vertical format. Now we are going to look at the determination of net profit or loss. So we shall have those items that are to be debited and those items that shall be credited. So let's start with the items that shall be debited. Now here we have things like management expense. So the expense incurred for carrying out the day-to-day administration of the business shall be debited. Then you have selling and distribution expense. So these are expenses which are incurred for selling, distribution of products, services, as the name indicates. So then you have the maintenance expense, which are expenses incurred for maintaining the fixed assets of the administrative office in good condition. Then you have the financial expense, expense incurred for arranging finances necessary for running the business. They may include interest on loan, discount on bills, brokerage, legal expense for raising loans, etc. Then you have the abnormal losses, these are losses which may arise during the accounting period. Then you have the wages and salaries. So these are earned by workers. We either pay them, otherwise we can also look at the rent, electricity, telephone expense are due to be taken into the consideration in the accounting period. So let's continue. So you also have to look at the items that we shall credit on the uh, on our side for determination of net and net profit or losses. So we are going to start with the gross profit as we have calculated above. So we are going to credit it on the credit side. Then you also have any other incomes. So sometimes business might be generating some profit, which is not due to the sales of its good or services. Then you have non-trading income. It may have various transactions with the bank. So we are also going to credit that. Abnormal gains, this one are arising out of sales of fixed assets. So we shall also going to credit that. So let's continue so that we can see. So we are going to look at the ascertaining the net profit and losses. How are we going to do this? And so that we can also look at the format and anything else that we might see. So you can see we have ascertaining the net profit. So we shall look at the format and see if we can be able to have an illustration at the end of it. So we shall include the name and then the title, the name, income statement of that 1st December 2010. So we are going to populate the format of finding gross profit at the start. So we shall have the sales, then we less the returning ones where we shall be able to get the net sales. Then we continue. Then we have to less the cost of sales, which we include the opening stock, the purchases, any we add any carriage inwards. Then we shall also deduct the return outwards, where we shall have now the cost of good available for sales. Then we shall also deduct the closing stock, so that now we can get the cost of sale, which we shall deduct from the net sale to get the gross profit. So this is the gross profit. Now from here we are going now to add the income. So we have discounts received, rent received, interest received, other incomes, so that we can be able to get the gross income. Then this is what we have said shall be credited. Then on the debited side, we shall now deduct the expenses. So they can be many, so we shall take a few. We have carriage outwards, discount allowed, postage and stationery, salary and wages, rent paid, insurance and rates, bank charges, other expenses. So the total we deduct it from the gross income, so that we can be able now to have the net profit or net loss. So that is the format. Hope we are together. You are able to take some screenshot as we learn. Okay, let's look at the illustrations. We can also pause the video and also take some screenshots. So let's go at the illustration. We are told from the foreign trade balance of P. Nyangweso, draw up a trading profit and loss account for the year ended 30 September 2012 and a balance sheet as at that date. So here we are combining the profit and loss and also the balance sheet. So let's look at the trial balance. We are told we have the stock of that, the carriage outwards, carriage inwards, return inwards, outwards. So the purchases, we have the sales, salary, wages, rent, insurance, motor expense, office expense, lighting, expense, general expense, premises, motor vehicle, features and fitting, debtors. You also have creditors, cash at bank, drawings, capital, all that. So we are going to start with the profit and loss account. So for the profit and loss account, we have the title, P. Nyangweso Trading Profit and Account as at that December, that September 2003. Then we have now to study the sales. He sold for 186,000. We less the returning ones so that we can be able to get the net sales. Then we have less the cost of sales. We have the opening stocks. We also have the purchases of 118,714, carriage for 310, 3,100. Then we have to raise the return outwards so that we can be able to get the cost of good available for sale. We shall also deduct the closing stock so that we get the cost of sale of 112,840, which we shall deduct it from the net sales to get our gross profit of 71,110. Now in our trial balance, we don't have anything to be credited, so we don't have the incomes. So we are going to go direct to the debit side where we shall deduct the expenses. So we have all these salary wages, carriage outwards, the rent, the insurance, motor expense, office expense, lighting and heating, and general expense. So a total of expense is 58,040. So we deduct it from the gross profit to get our net profit of 13,070. So that is all about the calculation of net profit and loss account. I hope we are together. You can take some screenshots as we continue. So for the balance sheet as at that date, I have another video that I showed you how to calculate the balance sheet. So we are not going to do that for today. Let's first of all handle the profit and loss account. So let's continue. For the statement of financial position, we shall now compare the difference between trial balance and the financial position. For the trial balance, it will check arithmetic accuracy of accounts book, while the financial positions reveal the financial position of the business. Okay, another thing that we can look, trial balance document total debit balance is equal to total credit balance. For the financial position, it shows total asset is equal to total liabilities and stakeholder equity. Then trial balance prepared before income statement account preparation. Then we have for the financial position prepared after income statement account preparation. Then for trial balance, doesn't contain the value of the closing stock of goods. For the financial position, contains the value of the closing stock appearing on the asset side. Okay, you can also continue. Trial balance, expense due but not paid at incomes due but not received do not appear. For the financial position, expense due but not paid appear on the liability side, and income due but not received appear on the asset sides. Then you also have columns are named debit and credit. For the financial position, the two sides we have the assets and the liabilities. Then on the trial balance, list of balance extracted from the ledger account. we get the balance on the ledger accounts. For the financial position, contains only balance of those accounts which represent asset and liability. Then we also, for the trial balance, it contains balance of all accounts, real, normal, and personal accounts. For the financial position, contains balance of only those accounts which represent assets and liabilities. So that's all about trial balance and financial positions. So we are also going to look at the preparation and presentation of statement of financial position, the things that we need to involve ourselves with. So we are going to look at the classification of assets. So we have the non-current assets. As you can remember, in our introduction, we said we arrange them or we name them in the order of performance. Then we also have the another assets. We also have the intangible assets, like the patents. And then we also have the current assets. We also remember this, we talked about the order of liquidity, which items is far from being converted into cash. Then you have liquid or quick assets. Then you have purchase assets. You also have the wasting assets, contingent assets. So all these are assets that we can classify them as on the side of the assets. And then we are going to look at the classifications of liabilities. We don't have many here. We only have the non-current liabilities or the long-term liabilities. Then we also have the current liabilities. We define this one that you have to arrange or list it in the order of payment, which is due to be paid. Then you have contingent liabilities. So we can say they may or may not be sustained by the entity depending on the outcome of the future events such as court cases. We call them the contingent liabilities. Now, we are going to prepare financial position under incomplete information. So we can have this so that we can be able to create a financial position. So an incomplete record situation is whereby the accounting system fails short of the double entry. So it fails short. This may be due to lack of records at all or insufficient records that will facilitate the preparation of final accounts. Why do we have the reasons for incomplete records? So one, managers or owners may not have the skills or expertise in preparing and maintaining an accounting system. So the expertise, records and procedure, the managers may not have that. It may not be economical for the business to maintain accounting records due to the volume or nature of transactions. Small scale business may fall this. Then their records are destroyed or stolen or misplaced. Then we can also look at the approaches in preparing final accounts where there are insufficient records. So we have this, the first which we can use, the estimating income from the net assets, whereby profit or loss, the formula equals to closing capital minus opening capital plus drawings minus any additional capital. So let's look at the illustration so that you can be able to utilize this formula. As you can see, estimating income from the net asset. So illustration shows that a sole trader capital position is as follows. So you have the motor vehicle, the costs, that is the depreciation. You also have the stock, debtors, bank, cash, and the total. You also have the creditors and the net assets. So he has estimated his drawing of year 203 at shilling 12,500. Estimate his net profit for the year. Okay, please take a screenshot for that. Okay, let's continue. For the solution, we are going to utilize the formula. The net profit is equals to closing net assets of opening net assets plus drawing minus any additional net assets. So you can see we have a net assets or the closing net asset of 7,349. Then we also have the opening net asset of 6,938. Then we are also told we add the drawings, which you have been told is 12,500. Any additional net assets we don't have. So after calculating, we get profit and loss account for, or the net profit for 12,911. So that is our solution on estimating the income from the net assets. We can continue. Our next one is to use of ratios. So here we have gross profit margin. So when you use this ratio of gross profit margin, we can say that gross profit or sale or the selling price, gross profit you divide by sales or the selling price, you multiply by 100. So we are going to get the gross profit margin. So for the markup, you are going to the gross profit margin. You can get the gross profit, you divide by the cost of sales or the cost price per unit multiplied by 100. Then we also have the stock turnover, which will measure the rates of firm uses its stock to make sales or turnover. Here we have the cost of sale, you divide by average. The stock turnover, we have the cost of sale, you divide by the average stocks. For the average stocks, we are going to get it by adding opening stock plus closing stock divided by 2. So you get the average stocks. Hope we are together up to there. So if you have any question, please write it on the comment. We are going now to look at the use of cash book and bank statement. In addition, control accounts. So for the control accounts, we are going to show the steps in preparing the final accounts. Here, prepare a statement of affairs at the beginning of the period, a list of all assets and liabilities, determine the beginning capital. So you have to do that so that you can be able to determine the beginning capital. Then you have to open and post the balances and transactions to these 3 relevant accounts. So the cash book for both cash in hand and bank, you have the sale ledger control account and purchases ledger control account. Shall also make adjustments for any accruals or prepayments, extract a list of the balances and the trial balances, and prepare the final accounts. So these are the steps in preparing the final accounts. So we can also look at the limitations of financial statements. So which are these limitations? So 1, the management has a choice out of a number of accounting policy in variation of inventory, depreciation, provision of gratuity, treatment of research and development expenditure. Another one is that there are numerous parties which are interested in the financial statements. Also, the fact that the quantitative factors translated in terms of money are the only factors which can be revealed in the statements. Another one is that great deal of effort these days is being directed towards evaluation of human resource at the disposal of undertakings. Another limitation is suffering from the great fall in the value of money. So this is all that I wanted to discuss today. Please, if you have any question, please write it below in the comments. And also, I can also have a personalized time coach you, and we learn for the better tomorrow. Okay, thank you. Bye. There are a number of ways in which a partnership may be defined. Okay, so a partnership includes at least two individuals, and the maximum number of people who can form such a partnership under the law is 20. Okay, it also involves a business arrangement, profit motive, and also is an incorporated business entity, which means the principle applies to a partnership. So for accounting purpose, the partnership is a separate entity from the partners, or the partners have unlimited liability, and if the partnership is unable to pay its liability, the partners may be called upon to use their personal assets to clear unpaid liabilities of the partnership. So we have the two types of partnership. We have the general partnership and the limited partnership. Let's continue. So here is a partnership agreement. The partnership agreement, the names of the firm and the location of the business. Then another one is the nature of the business to be carried on by the firm. The amount of capital to be contributed or left in the business by each partner. Then you have the ratio in which profits are to be shared. One partner may be entitled to a greater share of the profit because he has more expense or is doing a greater share of the work. Another agreement is that the rate of interest to be allowed on investment capital and the rate of interest to be charged on drawings. Salaries to be allowed to partners and other benefits such as commissions or bonuses. And you also have any variations in the usual rights for partners. You have the method to be followed on admission of retirement for partner. A method to be followed in the event of dispute among partners. You also have the duration of partnership, as well as the manner in which accounts are to be prepared and inspected. So those are the partnership agreements. Let's look at the rights of partners. So every partner has a right to take part in the conduct and management of the business. Then every partner has a right to be consulted and heard in all matters affecting the business of a partnership. So every partner has to be consulted. Then every partner has a right of free access to all records, books, and accounts of the business, and also to examine and copy them. Then every partner is entitled to share in the profits equally. Then a partner who has contributed more than the agreed share of the capital is entitled to interest at the rate of 6% per annum, but no interest can be claimed on capital. Let's continue. Then a partner is entitled to be indemnified by the firm for all acts done by him in the course of the partnership business. So for all payments made by him in respect of partnership debts or liabilities and for expenses and disbursements made in an emergency for protecting the firm from loss, provided he acted as a person of ordinary prudence would have acted in similar circumstances for his own personal business. Then every partner is, as a rule, joint owner of the partnership property. Is entitled to have the partnership property used exclusively for the purpose of the partnership. That is also another rights. Then a partner has power to act in an emergency for protecting the firm from loss, but he must act reasonably. Then every partner is entitled to prevent the introduction of a new partner into the firm without his consent. Then every partner has a right to retire according to the deed or with the consent of other partners. If the partnership is at will, he can retire by giving notice to other partners. Then every partner has a right to continue in the partnership. Then a retiring partner or the heirs of a deceased partner are entitled to share in the profit earned with the aid of the proportion of assets belonging to such outgoing partner or interest at 6% per annum at the option of the outgoing partner or his representative until the accounts are finally settled. So those are some of the rights of the partners. Now let's look at the duties of partners. So every partner is bound to diligently carry on the business of the firm to the greatest common advantage, unless the agreement provides there is no salary. Another duty is that every partner must be just and faithful to the other partners. Then a partner is bound to keep and render true, proper and correct accounts for the partnership and must permit other partners to inspect and copy such accounts. And every partner is bound to indemnify the firm for any loss caused by his willful neglect or fraud in the conduct of the business. The partner must not carry on the competing business nor use the property of the firm for his private purpose. In both cases, he must hand over to the firm any profit or gains made by him, but he must himself suffer any loss that might have occurred. Also, every partner is bound to share the losses equally with the others. The partner is bound to act within the scope of his authority. And no partner can assign or transfer his partnership interest to any other person so as to make him a partner in the business. So those are the duties of a partners. Please, if you have any question, write it on the comment and I will discuss it below. And also for any personalized coaching, please reach to me through the comment. Also, you can take the screenshots as we continue. So let's continue. Now we are going to look at the powers of our partners. So we have the buying and selling of goods in case of a trading firm, then receiving payments on behalf of the firm and giving valid receipts, also drawing checks and drawing, accepting and endorsing the bills of exchange and promissory notes in the name of the firm. Okay. Also, borrowing monies on behalf of the firm with or without pledging the stock in trade. Also, engaging servants for the business of the farm. So those are the powers of the partners. So we are going also now to look at the case A. Cases a partners has no powers. There are those cases that a partner will not have the powers, like submitting a dispute relating to the farm to arbitration. Also, opening a bank account on behalf of the farm in the name of a partner. Also, compromise or relinquishment of any claim or portion of claim by the farm. So, withdrawal of the suit or proceeding filed on behalf of the farm. We also have admission of any liability in a suit or proceeding against the farm. Also, we can also talk about the acquisition of immovable property belonging to the farm. Also, transfer of immovable property belonging to the farm, as well as entering into partnership on behalf of the farm. So those are the cases a partner will not have powers. So like also we look at the types of partners. So we have various types of partners. The first is, we call him the sleeping or dormant partner. Is the one who is in reality a partner, but whose name does not appear in any way as a partner, and who is not known to outsiders as a partner. So this is a sleeping dormant partner. We have a, but as well, he is also liable to those third parties who subsequently discover that he was or is a partner. So he has no duties to perform, but he has the right to access to the books of account and of examining and copying them, even if he is not in reality a partner. Then we have the nominal partner. So this one is a person whose name is used as if he was a member of the firm, but who in reality he is not a partner. So these are the two different. In nominal is the name which is used, but in sleeping, in reality he is a partner, but he does not appear in any way as a partner. Okay, let's continue. And as well, this partner in profit, the nominal partner is liable to those third party who give credit to the firm on the strength of his being a partner. And also in profit only is one who get a share of the profit and does not share losses. So he is liable to outsider. He doesn't take part in the management of the business. We have the partners by estoppel or holding out. So is the one who, without really being a partner, so conduct himself as to lead others to believe to be a partner. So similarly, if one is declared to be a partner and does not disclaim the partnership, one will be treated as partner by holding out. So such person is liable to those third parties who extend to the firm on the behalf of that such person and partners. So that is what's done by estoppel. Then we have the sub-partners. So he get a share of profits of the firm from one of the partners. So the sub-partner has no right against the firm, and he is also not liable for its debts. Okay, let's continue. We continue. We have the incoming partner. This one is who is newly admitted to the firm. So if he is newly admitted to the firm, he is not liable for the debts and the obligation of the firm incurred before his joining the firm unless he so agrees. Then you also have the retiring or the outgoing partner. He continues to be liable for obligations incurred before his retirement, and he will continue to be liable even if for future obligations. He does not give public notice of his retirement. So he is an outgoing partner. He continues to bear the obligations. Then we also have the minor partner. This one admitted to the benefits of an existing partnership with the consent of all the partners. So the minor is not personally liable for the debts of the firm, but his share within the firm, within the partnership property and profits of the firm will be liable for the firm's debt and obligation. So he can also bring a suit for accounts and for his distributive share when he wants to sever his connection with the firm, but not otherwise. So that is all about the partnership. So let's continue. Hope you are taking some screenshots as well as some notes. So in the absence of any agreement, sometimes there is the partnership has not made any agreements. So in the absence, no partner has the right to the salary. So there will be no salary. Then no interest is to be allowed on capital. So if allowed, it is an appropriation of profit and a charge against it. So if the profit is less than the interest to be allowed on capital, the interest will be limited to the profit. In case of losses, no interest will be allowed. Then there is no interest to be charged on drawings. Then interest at the rate of 6% is to be allowed on partners' loan to the firm, as well as the profits and losses are to be shared equally. So those are the things to be done in the absence of any agreement. Let's look at the introduction to partnership accounting. So we are going to look at the things we are supposed to do in the partnership accounting. We have the share of residual profits. So amount of profit available to be shared between the partners, the profit and loss sharing ratio after all other appropriations have been made. So this is what we call the share of residual profits. Then we also have the interest on drawings. So this one is a debit entry in the partners' current accounts and credit entry in the appropriation account. So that will be also in the accounting. And then we also have the appropriations of profits. So the income statement will be debited, but the profit will be credited to the appropriation account. Then you also have the partners' salaries. So you have to debit entry in the appropriation account and also credit entry in the partners' account. So usually the current account before the residual profit is shared. So that is about the partner's salary. So let's continue. Also the interest on capital, we have a debit entry in the appropriation account and also and are completed by a credit entry in the current account of the partner to whom the salary is paid. So that is on the interest of capital. Then interest on drawings, you have a debit entry in the partner's current accounts and a credit entry in the appropriation account. So these are the partnership accounting treatments that we need to undertake. So we can continue. We have a distinction between current and fixed capital. So a partner's total capital is the sum of the balance on their capital account and their current account. So the total capital. So a capital account is usually fixed, while the current account is the current total of appropriations and the share of residual profit or loss less the drawings. So these are the distinctions between a current and a fixed. So for capital account is usually fixed, while the current it involves all the total appropriations and the share of residual profits, stroke loss, minus the drawings. So let's look at the formats of both. So for the current account format, we draw a T format like this one, where we shall have a debit and credit side. Then on the debit, on the left hand side, we shall have the balance brought down for the partners. Then we have the interest on drawings shall be on the debit side. Also the drawings shall also be on the left side. On the right side, right hand side, credit side, you have the balance brought down. As you can see, the interest on capitals. So you have to have the interest on capital, and then the salaries, the share of profits, and their own interest. So both sides shall have the balance carried down. So after we earned, so the difference is what we shall write below the balance brought down on the differences of any of the both sides. So we shall have it as that. So this is the format for the current account. For the fixed capital, it is the same case, whereby on the left hand side you have the loss or variations and goodwill written off. So those are on the debit. On the credit, you shall have now the balance brought down. You shall also have the gains on variations. Also, we shall also have the additional capitals. So we shall have these additional capitals. 1 minute. So additional capital, the cash book or the assets, shall also have them. Then you shall also have the goodwill balance carried down. So the difference, then you shall also have the balance brought down. So these are the two fixed, the two format, the fixed account, the fixed capital account, and the current capital account. Then we also have the format for the appropriation account. So we start with the net profit for the year. So you have to have that, whereby we now add the interest on drawings for all the partners, their names. Here we are representing them as A, B, and C. So we add their interest. We shall have to raise their interest on capital. Then we shall also raise their salaries. Then after that, we are going to get the balance of profit to be shared in percentage ratio. So this is the ratio of their contribution to the partnership. So the profit, you have to multiply with their ratios, so that at the end you shall get a nil balance. So this is the format of appropriations. So let me give you a minute. Take the screenshot for the current account. And please, if you have any question, please write in the comment. I'll get back to you in a moment. As well as any personalized question, you can reach at me through the email or through the comments. You have the fixed capital, can take a screenshot for that. Then you also have the format for appropriation account, as you can see. So this one will depend with the things the members have done. If there are no salary, no interest, they are not going to involve to add that on the appropriation account. So let's look at the illustration below. So we are told presidential premium and the foreign profit sharing clauses in their partnership agreements. We had a 5% interest on capital based on average balance. A Clinton 40,000 opening balance. Then we have the Bush. We are told 60,000 opening balance. Obama 20,000 opening balance. Then we also told the 5% interest on current based on opening balance, except if they are overdrawn. I have Clinton 10,000 opening balance, Bush 5,000 opening balance. We also have Obama 5,000 opening balance. We have the interest on the advance from Clinton is paid at 5%, treated as an expense. We have Clinton loaned the partnership 30,000 at the start of the year. Then you have 10% interest. 10% interest on the average level of drawing during the year. Drawings made evenly throughout the year. This is 15,000 at 5. Then we have 10% interest on average level of drawing during the year. The drawings were made evenly throughout the year. Then we are told 20,000 on Clinton, 30,000 on Bush, and 20,000 on Obama. We also have told residual profit or losses are shared in the same ratio as the partners. Capital contributions, salaries, partners. We also have 50% on Clinton, 50,000 Clinton, 60 on Bush, 45 on Obama. Then the last, the partnership made a profit for 250 during the year. So Bush contributed 10,000 van halfway through the year. So required an appropriation statement. So here we are told to make an appropriation statement. So we are going to look to take this format for the appropriation account. So the first thing we are going to start with is the net profit. So you can take a screenshot for this one. So we shall start with the net profit. So we are told that a partnership made a profit of 250,000 during the year. So that will be our starting. So writing the title, appropriation statement for presidential cleaning for the year ended 31st March 2014, as that is their year ended. So profit is 250. So we have to less the interest. So the interest on loan, we have 15,000. 1,500, not 15,000. We have 1,500. Let me see where it is. So the interest on loan on Clinton, we are told that interest on the advanced loan from Clinton is paid at 5%, treated as an expense. So Clinton loaned the partnership 30,000 at the start of the year. So the 5% of 30,000 is the one that we are now going to take as the interest on loan, which will be 1,500. So you have to raise that from the profit. We get 248,500. Then we also have to earn interest on drawings. So we have interest on drawings. We have for Clinton, Bush, and Obama. On the second part, add interest on drawings. So here we are told that Creton on note 4 we are told that 10% interest on average level of drawings during the year. Drawings made evenly throughout the year. You have shilling 20,000 Clinton, 30,000 Bush, 20,000 Obama. As you can see from note 4. So this one. So since these are the drawings made evenly throughout the year, we are going to trace the 5% on the current based, except if they were overdrawn. So we are not going to trace that for 10. So for the 5%, which you have been told is the interest on the current based, so the 5% on the 20,000, which was made evenly throughout the year, so shall give us 1,000 for Clinton, for 30,000 for Bush shall give us 15, and also 20,000 for Obama shall give us the 1,000. So we add the interest on drawing to get that 5. So the total will be 252,000. Then we have to raise the interest on capital. So we are told that the capital contributed by Clinton, Bush and Obama. So we shall look at our instruction. We have been told the 5% interest on capital. Let me find that. 5% interest on capital based on average percent. So if you can look at this, we are told the 5% of 40,000. So we shall have 2,000. So the interest on capital is 2,000. For Bush, it is 60,000. But he had also contributed. Bush contributed a 10,000 van halfway through the year, so half. So plus 5,000, which is shall multiply by 5%. So the 5% will give us the 3250, and then we have a contribution for Obama, which is 20,000. So which will give us 1,000. So the interest on capital we shall get as 2,000 for Obama, that 250 because he contributed 5,000 more, and then we also have 1,000 for Obama. So we less that, which is 6250 to get 245,750. We shall also have to less interest on current. So the opening balance here, we have been told 5 interest on current based on the opening balance, except if they are overdrawn. So and we are told interest on the advance from Creton is paid 5%, treated as expense. So Bush had an overdrawn, so we are not going to calculate the interest on that. So we get interest for Clinton, which is 5% on the 10,000, which is 500 at Obama, and the 5% for the 5,000, which is 250. So we shall also add both and we less. So we less from interest on capital to get 245,000. We shall also less their salaries. So we are told salaries, residual profit or losses share in the same ratio as the partner's capital contribution. So salaries for partners is 50 Clinton, 60 Bush, and 45 Obama. So the salaries, we have Clinton 50, Bush 60, and Obama 45, where you shall have a less of 155,000, which shall equal to 90,000 after you subtract. So the share of their residual profit or loss, we have been told that a residual profit or loss are a share in the same ratio as partners, capital contribution, salary for partners. So we shall go to their capital contribution. So we have 40 for Clinton, 60 and 20. We add, since we have not been given the ratio, we can find it. So we add the 3 to get to 120,000. So 40 divided by 120,000, that is 0.33% for 60 divided by 120, that is 0.5. This one is 0.1667%. So we shall use those ratios to divide the residual profits. So for 0.33% times 90, we shall get that percent. 0.5 times 90, get 45% for Bush, and the rest will be for Obama, which is 0.16 times 90, get 15%. So that when you subtract, you get a nil balance. So as you can see from our format, which has a nil, you share the residual profit, you shall get a nil balance. So that is all for today. Please subscribe, comment, like the video. If you have any question, please write it on the comment below. And also, for any personalized study, please reach me in the comment below, and I'll gladly help. Thank you. I'll see you next. Welcome back. Today I want to look at the financial statements of a company. We have two types of company: private companies and public companies. So the capital structure of this company may include the initial issues of shares at full price, right issues, and bonuses. Also refer to the percentage of capital or the money at work in a business by type. So those are the definition of a capital structure. So you have the equity capital. So this is the money put up and owned by the shareholders or the owners. So that is the contributed capital and retained earnings. We also have the debt capital. Is infused into a business with the understanding that it must be paid back at a predetermined future date. So that's all about the debt. We also have the types of shares capital. So we have the ordinary shares. We can also call them the voting shares, common stock. Then this one, then we have the preference shares or the preferred shares or the preference shares or the preferred. Then you also have the issues of shares. So the issues of shares, the shares are issued at par value. This one shares issued at a price equal to the nominal values. We also have the shares issued at premium. We call these shares issued at a price higher than the nominal value. Then we have shares issued at a discount. We have shares issued at a price lower than the nominal value. So those are the issues of shares. Then we have the right issues. It's an option on the part of the shareholder given by the company to existing shareholders at a price lower than the market price. So that is definition of right issues. Then we also have the bonus share. These are share issued to existing shareholder free of charge. So that is another definition of bonus share. Then you have the types of reserve. A company may have various types of reserve. You have the share premium, is the amount received by a company over and above the face value of its shares. So over and above the face value of its share, that is a share premium. A liberation reserve, any gain made on liberation of non-current asset, especially for land and buildings. And then you also have the capital redemption reserves, a reserve created after redemption or purchase of preference shares without issuing new shares. So that is also another reserve. Then you have debenture loans. It's used when a limited company receives money on loan, and certificates called debenture certificates are issued to the lender. Then you also have the retained profits, to the portion of the net income which is retained by the company rather than distributed to its owners as dividend. Okay, I hope we are together. So those are the types of reserve, and you should also take a screenshot as we continue so that you'll be on the same track. Then you have the income tax accounting treatment and presentation. So we would like to understand how we treat this income tax. So for deferred taxes, those are taxes that is payable in the future. For the current tax, this is a corporation tax payable by company based on trading result for a given period. For the accounting profit or reported profit, figure of profit before tax reported to shareholders in the published accounts. You have then taxable profits, figure of profit on which the taxation authorities base their calculation. So that is the taxable profit. Let's continue. We have permanent differences. So certain items not being taxable allowed. Then we have also differences which only impact on tax computation of one period. Another one is difference which do not have deferred tax consequence whatsoever. So that is permanent differences. For the temporary differences, or you can call it the timing differences, these are difference between the carrying amount of an asset and for tax purposes. So for deferred tax liability, you can have a taxable temporary differences arises when the carrying value of an asset is greater than its tax base. So that is what we define a deferred tax liability. We have deferred tax assets. So it's a deductible temporary difference arises when the tax base of an asset exceeds its carrying value. So these are the two differences of a deferred tax liability and deferred tax assets. Okay, take some notes on that. Let's continue on the income tax. So we have revaluation of non-current assets. So for deferred tax, should be recognized on revaluation gain even when there is no intention to sell the asset or rollover relief available on the gain. The result in taxable temporary difference, and so its liability. So you have to recognize that. And the tax losses are carried forward on deferred tax asset and can be recognized to the extent taxable profit will be available in the future to offset the losses against. So those are the tax losses. Then you also have taxable temporary differences, the TDT. As we have seen, it is the difference that lead to a future payment of tax, deferred tax liability. As you can see, we have talked about it here. Deferred tax liability, a taxable temporary difference arises when the carrying value of an asset is greater than its tax base. Then you have deductible temporary differences, DDT, temporary differences that lead to future tax saving, deferred tax assets. So for deferred tax assets, we should see it's a deductible temporary differences arises when the tax base of an asset exceeds its current value. So the two are the same. So you can define it as a temporary difference that lead to future tax saving, or you can apply this one for arises when the tax base of an asset exceeds its current value. And vis-a-vis for deferred tax liability, or TTD, taxable temporary differences. Let's continue to the financial statements. So when we want to create the financial statement of a company, there are items that we shall include. So items to be included, we have we trace the format for the sole. Is the same as that one for the sole traders, but we have to include other items. So there are additional expenses that are unique to the company, and therefore we shall include them in the income statements. So we have the director's fees, salaries, and other expenses. We shall also include audit fee. A company need to have to be done its audit, amortization, e.g. this one for goodwill, debenture interest, corporation tax, appropriation account. So all these have to be included. So we have for the format, we shall iterate that one for the sole trader, and then we add these items. So let's go ahead and do that. So this is the format. So we start with the title, company income statement format for XYZ. So company income statement format, we have XYZ company income statement for the year ended that 1st December 2013. We have sales, we less return inwards, we get the net sale. As we said, this is the same as that one for the sole trader. Then you have to subtract the cost of sale, which involve the opening stock, we add the purchases, and we add the carriage inwards. You shall get the cost of goods. Then you less the purchase returns, you less the closing stock, we get the cost of sale, which is you shall subtract from the net of sale to get the gross profit. So we shall add the incomes for the company, or the incomes that you have received. We can have discounts received, profit on disposal, e.g. sale of assets, income from investment. You can also have other incomes, e.g. interest received from bank. We get all that, we get the gross income. We shall now less the expenses plus the additional expense. So we have the director salaries and the fees, the audit fee, we have talked about that, debenture interest, the amortization of goodwill, then operating profit for the period, we shall have that. We shall also earn investment income. Then, so the operating profit of the period, we earn the investment income. So the profit before tax, after we deduct the expense, then we shall also now the corporation tax. We can also corporation tax, we have transfer to deferred tax, we can have that under all of our provisions. So we subtract any of that. So we get the profit after tax, which we shall get that. Then we will have to let's transfer to the general reserve. So we transfer to the general reserve. We raise that. We also raise the dividend, and then we shall also have the preference dividend. We can also have a combination of interim paid, what we have paid, final proposed, then ordinary dividend. We can also have the interim paid and final proposed. So we subtract both of them. We get now the retained profit for the year. So and also we shall also bring the retained profit brought forward for the previous year, and then the retained profit carried down for the current year as the total. So this is what we call the format for the company income statement format. So you can take a screenshot for this. So you have said it's the general format for the sole trader, and then you add the additional expense for company, director salary, audit fee, amortization, debentures, all that. So we can also look at the company financial position, since it also have to have some differences from that of a sole trader. So we start with the company title. We have the XYZ company. We have the statement of financial position. We also shall be all the same, like that one of a sole trader, with a few adjustments. We can start with the non-current assets. We have the land and building, plant and machinery, features, furniture and fitting, and motor vehicle. So we can all have that. Then we can also add the intangible assets. Since this is a company, we'll have a goodwill, copyright, patents, long-term investment like the market value. All these will be under the non-current assets. For the current assets, we shall look at the order of liquidity. We can have the stock, the debtors. We shall also less the provision for bad debts. After the debtors, then we have the prepayments, short-term investment, cash at bank, cash in hand. So all these are under the current assets. We shall now introduce the equity. So the financed by or authorized share capital. You can talk about 1,000,000 ordinary shares for each, for shilling 1 each. You like there, reference share for 1 each, 100,000. And then issued and fully paid, you can talk about 80,000 ordinary share for 1 shilling each, 50,000, 10% each, preference share for 1 shilling each. You can also talk about capital reserves, share premium, revaluation reserve, capital reduction reserve, revenue reserve, general reserve, profit and loss account, deferred tax. All these will be under equity or the financed by. Then you have the non-current liabilities. You can talk about the 10% debentures. These are long-term loans. Then for the current liabilities, here we are going now to look at the order of repayment, the bank overdraft, creditors, accruals, interest payable, debenture interest, tax payable. We have also dividends payable, the current tax. All that will be under the current liabilities. So equity or the assets shall be equal to equity plus the total current total liabilities. So this is also another way to showcase your company financial positions. So you can take a screenshot for that. So let's continue and look at a illustration of a company. So We are being told that the foreign balance are extracted from the book of Kasaya Limited as at 30 September 2010. So here we are going to look at the land and buildings that be given their net book values. So we can also look at the plant and machinery net book value, motor vehicles, inventory, ordinary share capital. We have been told is shilling 50 per value. You have the 10% preference share capital, 100 shilling per value, then 10% debentures, corporate tax, interim, ordinary dividend paid, other operating expense, distribution costs, administrative expense, account payable, other operating income, gross profit, debenture interest paid, preference dividend paid, account receivable, cash at bank, capital redemption reserve, you have share premium, is revenue reserve as at October 2009. So we are told in the additional information, the balance on the corporation tax account represent an over provision of tax for the previous year. So tax expense for the current year is estimated at 3 million shilling. So on 15 September 2010, the director of the company proposed to pay the dividend due to the preference shareholder and to also pay a final dividend of 2 million to the ordinary shareholders. Then a building whose net book value is 5 million is to be revalued to 9 million shilling. Required an income statement for the year ended 30 September 2010 and also a statement of financial position as at 30 September 2010. So we are going to do that. So let's start with the income statement. So hope you have taken a screenshot for this question. So let's continue and go to the solution. So title shall state Kasaya Limited Statement of Comprehensive Income for the year ended September 2010. So here we are not going to start with the sales and all that because we have been given the gross profit. As you can see from our question, we have been given our gross profit to be 25,000. So we have the 30 up. So 25,000 is where we are going to start. So we indicate our gross profit. We add any other operating income that you have been told of 4,000. So we have operating income of 4,000. Guess that one is somewhere, yeah, here we have operating income of 4,000. So beyond that, so let's go to the expense. So we shall deduct all the expense that you have been given. So you have to understand all and check all the expense. So we have administrative expense, you have distribution costs, other operating expense, we also have debenture interests. This is 800. So that you get 21,350. So the net profit before tax is 7,000 after you have deducted the gross income, which is 7,650. So we have to calculate the corporate tax. For the corporate tax, we have working one. So this is the corporation tax account. The balance carried down, we are told, is 3 million. And the balance brought down was 500. So you can see from a question, we are told in the addition information to the balance of the corporation tax account represent the over provision of tax for the previous year. So the tax expense for the current year is estimated to be 3 million. So this is our balance carried down. But in our books, let me find that. In our books, we have been told the corporation tax is 500. So our books shows 500. So this means in the income statement, we have to show the difference, which is 2500, as you can see from our working. So you shall see this, it is 2500. So this is the one that we are going to show on our corporation tax. So go to corporation tax. We were somewhere, yeah. So our corporate tax will be 2500. So we raise that, we get 150 as the net profit after tax. Then we shall also now add the preference or subtract the preference dividend. So these ones we shall show them on the working two. So we are told the proposed preference dividend is 450. 450. Then we are also told the ordinary dividend is we are also given 2 million. So let's look at information, addition information. We are told the company proposed to pay a dividend due to the preference shareholder and to also pay the final dividend of 2 million to the ordinary shares. So we have the 2 million of this. But in our books, we have the preference dividend paid, which is 450, and also the debenture interest paid of 400. So let's first of all take that, the preference. So the preference dividend, which was 450. Then you also have the interim proposed of 450, which end up to 900. So yeah, it's 900. So we subtract that from our net profit to get earnings attributable to equity holders, 4250. Then you also have now the ordinary interim paid. We have said that from our questions, we are told it is 2 million. So director, due to the preference shareholder, and it will also pay a final dividend of 2 million. So this 2 million is the one that we are going now to subtract. So the 2 million for interim paid, and also the ordinary dividend proposed, yes, which is 2000 here. The ordinary interim paid, that we shall find it in our book. This one, the ordinary interim ordinary paid, which is 2 million or 2000. Let's continue. So after subtracting that, we get 250. Then we are being told that is now the retained profit for the year. We have the revenue reserve brought down, so which was 3000 in 209. So we add that to get now revenue reserve carried down to be 3250. So that is all about our income statement. So if you have any question, please reach on the comment as we go on. Let's continue. Now we look at the financial position. So Kasaya Limited statement of financial position for the year ended 30 December 2010. So we start with the non-current assets. So we have the land and buildings from our books, shows 29,000. And then plant and machinery, we have 8,000. Then we have the motor vehicles, 2,000. We get a total of 39,000. Then we also have the current assets. We have the inventory, 6, account receivables. We have for 20,000. Cash at bank for 100. Out of that 100 to give us total assets of 69,100. So let's continue. We go to the capital and the liabilities. So ordinary shares capital, they are being given for 10,000, 10% preference share capital, 100 each, 100 shilling per value. So we get that one to be 9,000. Share premium, 4,000. Revenue reserves, we have been given us from our total, from our income statement, we have seen is that 250. Liberation reserves, from our liberation gain, a building whose net book value was 5 million is to be revalued at 9 million. So we subtract that to see the liberation gain, which will add up to 4 million. So we subtract that. We have also been given a capital redemption reserve of 6 million, 6,000. So we add the capital together at 6,250. For the current liability, we don't have an current liability. So we go direct to current liabilities. We have account payable of 19,000. Then we have debenture interest, which was paid of 400. Corporation tax, we have been told it is 3 million. So you can see from our question. Tax for the previous year, the tax expense for the current year is estimated to be 3 million. So we are going to utilize that. So the corporate tax 3 million, proposed dividend. We have been given the proposed dividend 24.50. So the total to be 24,850. So we add the capital and liabilities. Now we have the wrong terms liability. Sorry for that. We have 10% debentures. We had been given that of 8,000. So we add the liabilities and the capital. We get 69,100. So this one shall be equal to the total assets. So this is what you are supposed to do for financial position for the company. So any question, please write it on the comment below. And also for any personalized study, reach me and I'll gladly help. So please take some screenshots so that you can revise by your own and be able to understand. Thank you. Like, comment and subscribe. Goodbye.